All right. Hello, fools. Hello, everyone joining from YouTube. I'm Lou Whiteman. This is Danny Venna with me. We are Fool24. We are here to answer your questions. Danny, how you doing today?
You know what? I am doing I'm doing spiffy this morning.
Spiffy. Okay, I like Spiffy. Let's talk about Spiffy in a second. But first, we should say to everyone out there, fools, YouTube, everyone alike, this, as the scroll says, is for educational purposes only. Danny and I are not going to try to provide you with financial advice. We can't give you financial advice. And frankly, you shouldn't want it from us because we don't know you. We don't know what's going on. We're going to give you our opinions, our thoughts, and we can't speak for the fool either. We are Motley. The Fool has many different opinions, so we are going to talk about our opinions. Danny knows all things tech. I know little bits about other things like industrials, financials. So please get your questions in. Danny, we called this hour "It's Never Too Late," and I might pick a nit with it because it sort of depends. It's never too late if you have the right company. But we have a company that I think does a pretty good job of illustrating this. Fools, when I first heard about a South American e-commerce company called Mercado Libre, it was because of the work Danny Venna had done. And Danny was way earlier to it than me. Danny, how early were you? What is your cost basis here on your first? Because I know there's been many, but where did you get into Mercado Libre?
So I first purchased Mercado Libre when the Motley Fool recommended this stock in early 2009. And at the time, the thesis was that Mercado Libre was copying liberally from the Amazon playbook. It was, bringing e-commerce to an area that historically had not seen e-commerce. And because the country was, well, actually, since the region and many of the consumers in the region were still using cash as their primary payment method, the company also came up with a digital payment solution that they called Mercado Pago. So you could go down to the Latin American equivalent of a 7-Eleven store, have an account there, give them money, they'd give you a receipt, and then you could use that account to make payments for things online. And this in an area that did not have a lot of checking accounts or a lot of credit cards at the time. So this was kind of a game changer. Um, I was intrigued and I thought, well, this would be like getting into Amazon a number of years ago, and that has worked out really well. So I bought my first shares of Mercado Libre. My cost basis at the time for my first purchase was about $21.50 per share.
$21. Okay, so now I'll be honest, I was not in on it then. I believe I was more like 2017 or so. By the time I discovered the stock, it was 6x from where Danny had bought it, basically, or if definitely 4x, maybe 5. My cost basis at the time I decided to buy in was in the 150s, I believe. And by any measure, it would have been easy to look at where it had gone over the few years between when Danny found it and I found it and say, well, I missed that one. Fair? It would
Fair.
be very easy to say. Well, I think we know kind of the punchline here, and Natasha just shared the screen, but both of us have done okay. Danny said the word spiffy. Of course, David Gardner coined the term spiffy pop for when your a stock goes up more per share in a given session than your cost basis. I said my cost basis was it's I think right around 150. Mercado Libre after earnings the other day, Danny went up what about 170 or so. So that was Danny is way back here on this list for those playing along, in the 20s here. I am all the way up here. Grandpa is, I don't know, somewhere around here, maybe. And if we only had that chart up, if I just put that chart in, it would look like the second half of that chart where so much up. And look at where it's gone since then. Fools, you can't do this for every stock. Okay. There are a lot
Indeed.
of stocks that just are not capable of this. And it would be insane for us to sit here and say, I don't know, Danny, make the argument, but I can't sit here and say that all stocks have to go up. So even if it looks expensive relative to where it was, you still need to buy it no matter what it is. But Mercado Libre is not the only stock that's done this. I mean, if you look at Nvidia, if you look at
Amazon.
if you look at Amazon, if you look at Netflix, it doesn't have to be tech too. We just look at a company like some that I love to talk about here, TransDigm or XPO Logistics, what they did in their run. Good companies are good companies, and their stocks go up because they are good companies. And if they can continue to execute, and if they continue to be good companies, their stock can continue to do what it's done before. Again, you have to do the homework. You have to find the right companies. They don't all do this, but it is so, so important not to shy away from a best of class company just because I could have gotten it cheaper 5 years ago. I think that's the theme for this, Danny. I don't know. Opine on that for me, but I think that is the message to get across here when looking at that. Yes.
Indeed. In fact, I will share with you that Amazon was one of the companies that got away from me. One of those ones where I kept meaning to invest, life got in the way, I'd forget. And then, pretty soon, here it is like, 2015. And, we're looking at a company that's already gone up, several hundred or several thousand times its original investment. And I'm thinking, well, I don't need to get all the winners in order to be a successful investor. But then I remember when Amazon stock fell, it was some ridiculous amount. It was 25% or 40% or something, because Wall Street didn't like its results. It didn't meet Wall Street's expectations. And I thought, okay, this is silly. Amazon's doing just fine. And I went ahead and bought the stock. And since then, Amazon has become an incredible winner for me. And that is one of the keys to this. I bought Amazon. It's up. It's an 8-bagger for me since I bought it in 2015. I didn't start investing in Nvidia until probably 2018, years after it was wildly successful. So, like you said, you have to do the homework. You find the successful companies, but price anchoring can be a portfolio killer. And for someone to say, well, I can't buy this stock because it's already gone up 100% or 200% or 300%, is you're cheating yourself out of potentially massive future gains.
Right, right. And I need input went to where I was going to go next. So let's just, in your words, I need input. Hey guys, this topic is really hurtful to me because I missed out on CMG at the food crisis, TTD around 300 pre-split, and Nvidia in 17 around 5 post-split. Three great companies. They have 2 of them now, but yeah, part of the lesson here too is that we can all do this. I don't think anybody. Well, I mean, I have an S&P index fund, so I guess I do. I'm the smartest person alive, Danny, because I have all of these. If you count my S&P or my total market funds, but look, we can learn from this, and nobody is going to have all of them. You don't need all of them. 1 or 2 of them will go a long way. It is a exercise in mindset from going forward. It is actually almost inevitably a painful thing to talk about in hindsight because we all miss those. We all miss those. I need input. I still only
Or
own one of
something.
those 3. Okay.
No, we all missed something.
Yeah. Yeah. I mean, I need input. You have one more of those than I do. Okay. So, and frankly, at this point with NVIDIA, because I have index funds, NVIDIA is like a top 10 holding for me, even though I don't own a share. So, I can't be bothered, but, yeah, you can't. And it's important to say you can't go the other way too. I let off with this, but you can't assume every stock does this. You have to find the special company that is able to do this, because most, quite frankly, can't. The lesson or the takeaway is that when you find companies that you believe are this caliber, that's when you don't let past price keep you away. It's not to say that, well, if it went up 100%, it's going to go up another 100 because that's how it works, because that's not true. But in times when you say, gosh, I really, really love this company, I see the future, next 12 months, 18 months, I see the next 5 years, everything that just looks realistic that's going to happen. I don't need to invent unicorns and fairy tales to get to some point higher in the future. I just wish it was priced lower. Yeah, those are the moments where you have to think about where it is. So, may we all find the next Mercado Libre, right?
Indeed.
Yeah.
And I think I heard David Gardner on a podcast once talking about a stock that he had decided not to buy because he was hoping it was just a little bit cheaper, and it went on to be a 10 bagger from there. And he said he missed out on a great ownership in a great stock over just a small amount, a few cents even, and never made that mistake again. So yeah, price anchoring can be a portfolio killer either direction. Um, I think one of the things that I really like about the Motley Fool, and subscribers will know this, is that if the Motley Fool finds a stock that it believes will be a long-term winner, not bashful about recommending it again, and recommending it multiple times. I remember Amazon was one of the ones where even after it had been going up for a decade, and after it had been recommended a decade before, it was still recommended again. So, it kind of reminds me of there was the situation with the trade desk last week where, earnings were not what was expected. The stock went plummeting. And
Down
I said something
30%.
about, yeah,
Yeah.
I said something about looking at the stock and the results and, looking at management's commentary and thinking, well, this is not deserving of a 40% decline. I'm hanging on to my shares. And one viewer said, oh, that's great for you because, what about those of us who got it at $80? Okay, well, I would say great that you got it at $80 and nothing has changed much. And that you could get that same stock now for about $73. I don't think personally that the thesis has changed. I think we had a quarter of difficulty. So yeah, things like this happen, but don't let one quarter of results scare you out of a stock with a long track record of impressive growth.
And it is, just to finish the point, it is a mindset. And again, I mean, I can't say it enough that it's not true of every stock, but you have to. The funny thing is like when I worked in the industry, how many times, and again, part of like what an investment analyst does is predict the near term, not the long term. But how many times you would hear on a stock that it's run its race, like the rally is getting tired, stuff like that. And the conventional wisdom in stock investing, and I think this is outdated, I think it's changing, is that stocks can only go up so much and you either hit it or you miss it. And just entering into your calculus the idea that no, there are some companies that, again, if you look at the company and you say, wow, I don't know why this can't continue, don't let what it's done in the past bring you down. And I think that's what Motley Fool does very well. Yeah. I Need Input says, yeah, thanks, Motley Fool, for teaching me this lesson. I joined in 2020. If I had found it in mid tens, I could have retired by now if I wanted. I'm 49. But you know what? It's still, if we all get there. I mean, look, we could do 3 hours on all the things I screwed up when I was in my 30s. So don't worry about. All right, we
Really?
have questions
Not
coming
all
in.
day.
Probably all day, but
I know I
just
could.
just the ones that we could talk about in a public
So,
forum. Okay.
fair
So we
enough.
have questions coming in, Danny. I know you've seen a few. I've seen a few too. Do you want to go ahead and start us off? And fools, thanks. Please get them in. It's Slido, the keyword Fool24. If you'd like to get your questions in, please do.
So there's a couple of them that I can hit. Felix Fike from 14, 15 minutes ago said, what are your thoughts on AMD, Advanced Micro Devices, chip maker? How are they competing against NVIDIA and the other AI chip producers? Okay, now what I'm going to say here is controversial, and it is my own opinion. I own NVIDIA. I have owned NVIDIA for a number of years. I have several times looked at AMD. And the thing that I keep coming back to is I look at NVIDIA, they come out with a, state of the art processor, GPU, they call them graphics processing units. It turns out not only are they great for generating images in video games, they're also good at, because of the parallel processing or the ability to break down big computing jobs into smaller bite-sized bits. They can work really well for AI processing. And NVIDIA does that better than anybody. And NVIDIA will put out a chip, and then maybe 6 months or a year later, AMD will put out a chip that is almost as good as NVIDIA's, and then NVIDIA will put out a new chip that is, leagues ahead. And so my question to myself is, why do I want to own an also ran when I can own the industry leader, who has somewhere between 80 and 90 some percent of the data center GPU market, which is where most AI processing occurs? I think AMD will probably do fine. I think they have the potential to be a market-beating investment. I think they have, central processing units or CPUs that are competitive in the market. I know a lot of people that swear by AMD. I'm just not one of them.
Gotcha. Gotcha. Yeah. So just a few minutes ago, wait, hold on. Sorry. Let me bring it up here again. Vihan had asked Lou, I see some green in REITs while all tech stocks are blowing up with downturn. What's holding the gate here on the REIT side? It's not just REITs, but REITs have outperformed. It's kind of tech. I think it's more what's going on in tech right now. I shouldn't even share this because it's such an ugly screen. But if we look about, yeah, today REITs, this is how I do. You can see REITs are up about 0.5%. Consumer staples doing a lot better. And if you look over the last month or so, yeah, okay. So there has been, it's more consumer staples. It's more, I think, a story of what's going on in tech than it is what's going on in REITs. There's a couple of big name REITs that are actually down today. Realty Income, ticker O, had a quarter that, or an outlook that I think was a little kind of played into the health of the consumer. I think in general, though, REITs are seen as somewhat defensive and somewhat as a hedge against inflation. And a lot of what we've seen in the last few trading sessions, and we saw the consumer confidence number come out today, that was pretty weak. I think the weakest since August 2021, and inflation was cited there. This is, I think, just a normal market move in reaction to kind of the conventional wisdom of the moment. The idea on REITs in an interest rate environment is that if inflation is up, a lot of these REITs are basically just toll keepers. They are collecting rents and passing on the proceeds to their investors. If inflation is up, rents will go up, and so the proceeds will get passed through. So it is a good so-called hedge against these inflation. I think that's more what you're seeing here. I don't think anyone could say if it's a long-term trend, but right now, the kind of dominant market theme for the last week or so has been just a bit of uncertainty all over the place. And I think that's reflected in tech, which tends to be more speculative or more opportunistic. underperforming things like consumer staples and REITs that tend to be more defensive, for lack of a better word. I think it's just that big picture rotation, and of course that could last for a long time, or that could change on the drop of a dime. So we'll see. But I think that's what's going in there more than it is anything specific with REITs. Because REITs have been, depends on where you are, whether or not that's been a great earnings season for REITs, I'd say.
Fair enough. Sanjay JC from about 23 minutes ago. I understand Arista Networks, ticker ANET, primarily sells to Meta and Microsoft data centers. Who supplies equivalent networking gear for other hyperscalers, Google and Amazon, tickers GOOG and ticker AMZN? I think there may be a little bit of a disconnect here. Let's start by saying that Arista Networks is one of the leading providers of networking equipment. Their claim to fame was that they developed network switches that could connect high-speed servers and other devices on a network, and they had very low latency, which basically means near instantaneous connection and response times. And they have expanded. They have a whole suite of offerings, switches, routers, other networking equipment that's used in high-speed data centers and servers, helps connect across networks. They've got custom Ethernet designs that they have created just for AI. And I think saying that they primarily sell to Meta and Microsoft is kind of missing the point. I believe that Meta and Microsoft may be among their biggest customers, but I believe they sell to Meta and Microsoft and Google and Amazon and many of the major hyperscalers. And I don't know for sure, but I would suspect that there isn't any hyperscaler who uses just one company for these types of products exclusively. For an example, Cisco Systems is widely considered to be one of the leaders in the network switch market, because that's how they got their claim to fame. One of their claims to fame is they've got a significant market share in the network switching market. But then there are other companies that compete with Arista Networks. Aside from Cisco Systems, Juniper, Dell, ticker DELL, Broadcom, ticker AVGO. All of these companies compete, and there's a lot of overlap. So yeah, I think there's a lot of companies in the space. I particularly like Arista Network because they are focusing on developing state-of-the-art and these groundbreaking new solutions rather than hanging on to a lot of their legacy products. So I am an Arista Network shareholder. I also own all of the other stocks that were mentioned in that question: Meta, Microsoft, Google, and Amazon.
All right. Just a minute ago, Let It Ride asked, I'm trying to understand LDOS, Lidos Holdings better. Is it a software business? Is it similar to Axon or Celebrite? So Lidos, name taken from Kaleidoscope, which I love, and it's sort of a kaleidoscope of different things. It is the largest of the so-called Beltway bandits, these government IT companies. They have a couple of kind of areas where they're in. So the biggest part of the business is they, as the name implies, government services. They just provide outsourced services for various Pentagon and civil agency customers. This can be mundane. Some of it's like running the email servers for Health and Human Services or something like that. It's not all dark, top secret, but there is a lot of IT espionage work like that too that come into this, that tends to be the higher revenue stuff, the stuff we get excited about. The other side of their business is more of a hardware business, but it's not hardware in the traditional sense where they are a defense contractor where they're making, I don't know, battleships or fighter planes. They do a lot of the electronics, a lot of the sensors. I mentioned here before that they commissioned a hull from Huntington Ingalls, a big shipbuilder, provided all the electronics for it, and sailed it from San Diego to Hawaii and back with nobody on it. So they provide a lot of the brains behind government systems. They also bought a company down in Alabama that is very, very important to NASA in terms of some of their tech. So what you get with Leidos is it is a defense contractor in the sense that it gets most of its revenue from the US government. But it's not so much like Axon or Celebrate where it is just selling software. It is managing systems and kind of taking outsourcing, it would be what we call it in the corporate world, for the government, and then also this stable of electronics, sensors, high margin components, but just components that go on bigger defense platforms. It's a pretty decent business. When you look at defense, you want to try and find businesses that are kind of skating to where the puck is going, so to speak. And this is, post Cold War, the metal benders ruled the world, where just the ability to make a battleship kind of made you exclusive. Now, just like with everything else, the world has gone digital. The ones that can provide the electronics, provide the brains behind that metal and not just bend the metal, that's where you'll find value. And I think you'll find outperformance. And I think Leidos is a pretty interesting long-term choice there. Short term, who knows with everything going on, but looking past all the drama, it's involved in a lot of things that the government prioritizes.
So I've got a question from 2 minutes ago from Besties. Tech-heavy portfolios are getting sacked after hitting their highs 2 weeks ago. How long is this going to continue? Is this 21, 22 again already? I want to take a step back from that question and say, okay, let's look at what was happening in 2021. Tech stocks were at an all-time high. We were just coming out of the pandemic. Life was looking better. Things were improving. And then inflation hit. Now, we're talking about inflation that rose to more than 20-year highs over a short period of time. And with inflation hitting all these highs, that was sort of the catalyst that led to the economic downturn. I remember it was in November of 2021 when tech hit its high, when the stock market hit all-time highs, and then all of a sudden things started to gradually go down. So fast forward to today. Yes, we are still dealing with the lingering issues of high inflation. The Fed has begun lowering interest rates, but has hit the pause button because inflation is still a little bit overheated, trying to get inflation to come back down. So I don't think it's an apples to apples comparison to say that now is like what it was in 2021. I think the one thing that is similar is that the market is at new highs. Now, one of the things that you're going to see if you've been an investor for more than a few years is the fact that you see a 10% correction in the market at least 2 out of every 3 years. And we have not seen a significant correction since the market started going up a couple of years ago. We've already passed the second anniversary. We're in the third year of the bull market. We haven't seen a 10% correction. I wouldn't be surprised if we don't see a 10% bull market correction where things kind of hit the reset button before the market goes on to see new heights. So I don't know how long it's going to be that we see, a settling or a retrenching of tech stocks. I don't think it's 21, 22 all over again, but maybe you have some thoughts on that, Lou.
Well, so I'll say this. First of all, the bottom line is that, and Danny kind of hinted at this, is that, yeah, 2021, 2022 wasn't great. There was a time there, but look at where we are now. So for the long term, the one thing that you can guarantee is there will be downs and ups, and that over time, historically, the ups have outpaced the downs to the point where you make money. So for a long-term focused investor, that assume that maybe we are going to get worse from here and it'll still work out okay, I think is a good mindset. I will say I have had a hard time buying into tech for months now. I just haven't had any interest. It is, by my eyes, overvalued. Now, my eyes don't really matter, and there are times when I think that, and it can go up a long time from there. But look, we are. I can't predict the future. I look at some of the earnings from this quarter, and the themes I see from earnings are that the past was good, and the guidance is where everybody got screwed up. And that is because there is just a ton of uncertainty out there. And if you look at Washington, pro, con, whatever, I don't know. But when things are changing rapidly, that adds to uncertainty. That's what we're seeing in the consumer confidence numbers, too, I think. There's the inflation questions. This is just, it might all turn out great at the end, but in the moment when things are changing rapidly, the knee jerk reaction is tend to hide under the desk and not extend yourself. And so I look at that. I look at the fact that the transports just gave terrible guidance in this quarter. In other words, and this is the time of year, Danny, where they are renewing their rates for the year. So they have pretty good visibility with these big trucking companies and UPS and things like that. This is the time of the year after the book closes on the fourth quarter, but during the first quarter, where they are writing new contracts for the year. They are talking to their customers about their customers' appetite. There is at the very least a lot of caution among corporations right now. And back to what we said before about the REITs and the consumer staples outperforming tech, that is a typical thing that you're going to see at moments like this. So honestly, I think if you're going to ask me, and again, I can't predict the future, I can't say, but if I will it continue? I fear we could be in for a rough, volatile few months. Yeah, I do actually worry. I mean, not every day, but I do think it could be at best a little bit of a roller coaster, and at best, as Danny said, a bull market decline. Or it could be the start of a decline that lasts longer. I don't know. But I think at the end of the day, it will go away. It will. And if you have good investments, please don't sell into this. If you are in good companies, just kind of let it ride, because you don't, the worst thing to do is sell when it's down. But as a mindset thing, Danny, I'm an awfulizer. I would rather think that everything is going to go terrible. So just I'm mentally prepared for it and I don't panic if I'm right, and then just be pleasantly surprised if I'm wrong. And to me, this is an environment where I am just kind of buckling my seatbelt and preparing for the worst, just so I'm mentally ready for it if and when it comes, because all of the tea leaves that I like to follow would, if nothing else, indicate a lack of confidence in the near term. And so I think something's going to have to change. Maybe it's just caution, but I don't know. I do think it's headwinds, and I do think that the stocks that Danny is talking about over time, these best of class companies, even if they fall, will end up higher than they are right now over time. Yes.
I agree with virtually everything you said. And I guess there's another question about Arista Networks here. JQ from about 20 minutes ago said, why is Arista Networks, ticker ANET, falling every day? Should we worry about this company? I really want to share a screen here, because I think this can provide context. And I think context is really important. This is a company that just reported results not terribly long ago. The results were fine. Perhaps guidance wasn't what Wall Street was looking for, but look at the yes, there's a big fall in the stock price. You can see that right over here on your right. There's your decline in the stock price from, above $128 down to $91. Pretty significant move. Even after that move, if you look down here at the valuation, Arista Networks still, after the decline, is selling for 41 times earnings and 37 times forward earnings. Now, what that tells me is that this is a stock that was already richly valued. When they announced their results, the results were fine, in my opinion. I mean, if you look at it, they reported revenue that grew 25% year over year. It was up 6.6% sequentially. Earnings were good. There was a little bit of a concern about whether or not Meta Platforms was spending a little bit less. But then you see this correction right here, and a great deal of that had to do with the fact that you have a stock that was highly valued. And whenever there's any degree of uncertainty, the market takes that uncertainty and factors it into the stock price. And you see the stock price reset. And I think you're seeing some of that happen in various stocks across the technosphere. And a lot of that is because there were a lot of tech stocks that had really high valuations. And that's what happens. That's the nature of the beast. You'll see these valuations spike, and then there's uncertainty, and then the valuations will fall and they'll come more in line with the market expects, and then you'll see them start to climb again. That's just part of the cost of admission when you are an investor. Lou, there's a yeah, I don't know how much you follow Arista Networks or if you
Yeah.
had anything to add to
Yeah,
that.
no. I mean, I think you're right. I mean, I think the one thing is sort of a value person that I would point out is in that chart is that those price earnings, as you say, are extremely optimistic. I mean, not out of the question, not like crazy for tech, but there is a lot of growth built in. We've had a great run for tech, and it's kind of what I was saying the last one. It's just that yeah, there is a lot riding right now on like hoping that the last few years can be sustained. I think long term, again, I like the trends, I like the quality of the businesses, but I do think it's like you mentioned Trade Desk and what happened there. A lot of that decline is that they had never in their 33 quarters as a public company not hit expectations. So, like, I mean, you say price to perfection. Well, up until that moment, they had been perfect on that measure. So, a lot of this is that just understanding with lofty valuations, not that they're bad or not that they can't be sustained, but part of the sort of a lofty valuation is to a cynic's eye overreacting to the upside, right? Because you are assuming the best case going forward. That's why you assign the valuation. If something falls off, I don't think it's a surprise that it's an overreaction to the downside. A less valued company might give the same report and fall half as much because there wasn't that overreaction or reaction to the upside on the way. As Danny said, it's kind of the price of admission for being there. When I went ahead, Sanjay asked me about TransDiamond. I'd mentioned before TDG is the ticker, and they are the aerospace basically parts company that has had an amazing run, 1,000% in 10 years, and still kind of going with margins that Danny's companies would envy. You're making little pieces of hardware and getting a 40% plus margin on it. That's software stuff, right? But Sanjay says, I believe I've heard that TransDime's share of the parts of newer planes is less than earlier. Does that concern you, Lou, that the formula may one day stop working? That is true to an extent, but I'll give you a couple of counterpoints. First of all, well, yes, about 75% of their EBITDA comes from the commercial aftermarket, which is a fancy way of saying spare parts. So spare parts, not new equipment, is a very big part of this business. And it kind of makes sense, right? Because if Boeing is ordering a part, they have a lot more scale power in that order to get a good deal than if Delta needs 5 of them one year, right? So, and over the years, the Airbus and Boeing have tried to make their planes more just kind of off the shelf. So these unique to just this airplane parts are fewer. There's still a lot of them there, but you're trying to make it as cost efficient as possible. A lot of that is trying to get commoditized parts. So that in theory is a risk. A couple things I'd say though, as we all know, Boeing has had a lousy few years, and that has impacted the number of new planes coming off the lines. That will trickle for decades because these airplanes have 20 to 30-year lifespans as they are. Maybe not in the United States, but when a plane ages out in the United States as kind of part of United's fleet, there are places all around the world you can place that plane for another decade. The fact that we haven't produced new planes to keep up with demand will just stretch out the life cycle for all operating planes for a long time, which sort of mitigates any concerns. The second is that TransDigm will not stand still in the meantime. I mean, right now, I am pretty sure this is public that they are bidding for a huge chunk of Boeing's business that Boeing is having a fire sale on. TransDigm can continue to evolve with the market over this long runway, to use the pun, since we're talking airlines, that they have. So while that is a big risk on this company, I don't think that it is a thesis buster because I think A, there's still a lot to be extracted from what they have, and B, there's a lot of cash generation, a lot of time to keep what is basically a private equity firm that continues to roll up businesses and get the most of them. There's a lot of time to adjust that business and evolve that business with cash as the market evolves. So to me, it doesn't keep me up at night, but I think it is a fair criticism or concern about the company. Do we want to get Danny? I don't want to put you on the spot, but I need input. Wanted highest conviction, small, mid, and large stocks at the risk of giving individual advice, which we can't. And I throw that out because TransDigm was just mentioned. In my world, 75 billion or so is large cap. That's I don't buy super large cap, but again, and fools, this is not a buy recommendation because to some extent I haven't bought TransDigm in a while. I own a lot of it, but highest conviction, I have a 20-year track record of that model working, and I can see the aerospace trends. That's a very high conviction. Middle, geez, I have to think about it. But I'll give you one smaller. It's $1 billion or so, but they reported earnings today, and they kind of relate to Vihan's question before. But there is Easterly Government Properties, DEA. It's a REIT that is focused, as the name implies, on the government business. It has a dividend yield right now approaching 10 or coming into earnings 10%. I just got off their call. The market's been worried about their ability to pay their dividend and all of this government efficiency and what it might mean for a long time. I could be wrong because if all of the market says one thing and I say the other, it's probably best not to go with me. I mean, there's a lot of intelligence out there. I believe that if anything, they could be a net beneficiary of Doge. I mean, some of the things they own FBI offices all over the country. There was just an announcement today that the FBI, as part of its reorganization, would like to move agents out of Washington into the fields. Examples like that, where that is a very, I want to do more homework coming out of these earnings, but that was one that really struck me today. My conviction is higher than the market anyway, Danny, which, like I say, probably should scare me, but it is what it is. What do you got?
Well, when you say highest conviction, it's
that's not the number of convicts you think are going to come out of there.
Right.
You got that. Okay, good. Yeah. Sorry.
I have a lot of really high conviction stocks. I will mention a few of them. NVIDIA, if the size of the artificial intelligence market is anywhere near what some market commentators are saying. Even the most conservative estimates say $1 trillion over the next 5 years. If it's anywhere close to what people believe, NVIDIA will continue to reap the benefits of its industry-leading AI processors, I don't think we're going to see the much feared slowdown in AI adoption that has some in the market worried. Um, and I think NVIDIA continues to develop new markets for those processors. It was just a few years ago when the company was just a chip maker for gaming, and now it's gaming and the leading provider of processors in the data center market. And there are a lot of other opportunities. So NVIDIA is one of my highest conviction stocks, ticker NVDA. I'm also a big fan of the trade desk, ticker TTD. The stock has fallen almost 50% from its high. The last time I saw that happen, I got really excited. I doubled down on my position, and it stayed down for a little while, and then it went back up. And I expect that that's probably what we're going to see here. There are a couple of smaller companies that I'm pretty excited about. One of them is Portillo's, ticker PTLO. This is a regional fast casual chain that focuses primarily on Italian beef sausages, Chicago hot dogs, salads, chocolate cake, in-house made shakes. They have done remarkably well through the difficult economic period that we've seen. They decided not to raise prices because they wanted to give their customers a haven from the macroeconomic storm that we all went through. And the company just reported results today, and the results were actually stronger than what Wall Street was expecting. The stock was actually, I'm going to take a quick look here and see where we're at today. Or at this point, the stock's still up about 6% after hours. They generated same store sales that were positive for the first time in 4 quarters. Even though revenue was down, that was because we were comparing a 13 week or a 14-week quarter to a 13-week quarter. Same store sales were up. Earnings per share was much better than what Wall Street was expecting. And finally, another one in the food space, Dutch Brothers Coffee. They are a regional coffee chain that is doing remarkably well, carving out a niche for themselves in specialty drinks, secret menu. They're going up against the Titan Starbucks, ticker SBUX. Yet Dutch Brothers continues to grow at a really rapid pace. So it's one that I think has a great opportunity to be, a multi-bagger over time. And that's Dutch Brothers, ticker BROS. Lou.
Gotcha. All right. And we are almost at the top of the hour. And Fools, thanks for all these great questions. But there's a couple that's pointed at me, and I can't resist because Besties in particular is trying to get me riled up. He says, Lou, you don't buy tech stocks, so what's your highest conviction stocks? What are you looking at the time? I reject that, Besties. I own Mercado Libre, I own Shopify, I own Booking, I own ASML, I own Taiwan Semi, I own Upstart, I own Snowflake. There's others. I promise I do. My problem with tech is that I am, for all I said, it's never too late at the top is that, look, between my wife and I, we have a lot of things tied to the index in our retirement funds. I feel like I have plenty of exposure to big tech, especially with the way they dominate. And I would just prefer to spend my energy on things outside of that as far as where I look, because that's fun to me. That does not, and I look forward to a time when I'm buying tech again, to be honest. And maybe if I'm right about the next few months, that will happen. Highest conviction now. I've spent, and I've said this before, that I have to put a kid through college, so I am income focused right now. But I bought a ton of banks and REITs as interest rates were going up. I just kind of went flooding there because the market accurately said that a rising interest rate environment would dent earnings for a quarter or two. And so all the analysts dutifully and correctly lowered their estimates and did all that. And the stocks fell. But as someone who was looking past a quarter or two, I said, you know what? A lot of these companies, they're going to survive this interest rates going back to where they were for most of my lifetime. And so if you can look past the accurate prediction that the next few quarters things would look bad, you're getting sales. And that's where I looked. Those values have started to go away, but I actually think some of them are coming back. So as where I'm kicking around right now, it's mostly in kind of small cap daydreams and kind of speculative things, and still with the financials and the REITs. And real quick too, because it kind of relates, but Let It Ride said, Lou, how do you approach valuations with Lidos and TransDigm too? We've talked about, what do you think of current valuations? I'll be honest. Neither of them look like attractive to me. Let's take Lidos first. These government contractors, the federal budget only grows at 2 to 3% a year. Okay. You can't really do substitution. Microsoft might take business from Oracle in a way in the cloud, and like in any business, you can do that. But you are not going to say, all right, we have great software, so we're not going to buy an aircraft carrier. Right. So you just don't get the substitution where you can just really take market share aggressively from your competitors here. So they are sort of locked in a growth range, organic growth range, good, bad, indifferent. Second half of last year, the entire defense aerospace industry got overvalued to my mind. Lidos was among them. I usually look at the enterprise value to EBITDA is what I like, but I mean, up north of 10 times. I think they were up to towards 15. That is just outside of their historical range. It has dropped down with all the chaos and everything going on. I would say it is now appropriately valued. It doesn't really honestly look like a sale to me, but it looks like something that we're going to be more normal. TransDigm is one of those that always looks expensive because they just continue. Even during COVID, Danny, when nobody was flying airplanes, okay? You remember that, right? Just nobody was flying airplanes. And they sell spare parts for airplanes. And their margins stayed over 40% because we all learned that 80% of their costs were variable costs and not fixed. And so they just took a hammer to cost as quickly as they did what was happening to revenue. Of the two, TransDigm looks probably better valued to me. Neither would I'd call cheap, but TransDigm, you're buying, again, kind of a private equity story. You're buying the idea that they can generate cash, deploy that cash profitably, and build from there. And so that kind of business trading at about where it has for most of the last 2 years, again, I can't say this. You can't make a joke like this with an aerospace company, but I don't think the sky is falling, so to speak. So, of the two, neither are cheap, but probably that one is. That's how I would process valuation as you're looking at it for yourself in those names, at least.
So we've got from Besties 5 or 6 minutes ago. So, should we fasten our seatbelts for NVIDIA's earnings tonight? Quick correction, not tonight.
Tomorrow.
Today's the 25th. Tomorrow, NVIDIA is expected to drop their results sometime after the market close. The market closes at 1 p.m. Pacific time, and NVIDIA usually has their conference call at 2 p.m. Pacific time. So I expect about 1:20 ish Pacific time, about 4:20 Eastern time, and NVIDIA's results will drop. To the part, should we fasten our seatbelts? I have no idea. I think that there are a lot of expectations built into NVIDIA's business. I just took a look to see the stock is currently selling for about 29 times forward earnings, which is down, from before it, fell precipitously after the DeepSeek scare. A lot of it is going to have to do with expectations. And it's interesting because you might see investors say, okay, well, NVIDIA did just fine, but I don't know if they're going to continue to do just fine. So I'm going to lock in some profits and I'm going to, sell the news. You might see some other investors see it as a buying opportunity. We just don't know. I personally cannot tell you what's going to happen. Is the stock going to rise or drop like a rock? Not even a clue. There are only two outcomes. I completely disagree. The stock could sit absolutely still, either side of break even. It could go up, it could go down. We just don't know. And if you've got a crystal ball that works better than mine, more power to you. But I am excited. Yeah,
it's funny, Danny. The stock's been down this week. It's trading at levels that we have not seen since late January. There are children that are 2 weeks old that have never seen NVIDIA at these levels, which is to say, if we knew what NVIDIA was going to do after earnings, we wouldn't be sitting here. But it seems to me the least likely is it does nothing, especially in the after hours trading after the announcement. It'll either be up 10% or down percent. We saw it with Trade Desk. We saw it with a lot of them, Fools. If there's a fear for me there, and this is just looking at the entire earnings season, it's going to be, is guidance less robust than what people think, which it has been for a lot of companies, and it's affected them. I don't think that whatever the reaction is, it is the thing to focus on coming from earnings. And although it will be the thing that dominates the attention, I know, is whether or not NVIDIA is up 12%, NVIDIA is down 30%, whatever it is, that will be what gets attention. I would submit to you that whatever that ends up being, it's best to just focus on kind of the business and looking at the business and thinking about it, hopefully as a long-term holder, and not what it does in the after hours tomorrow night. I don't know. Crazy thought, right?
Because it could indeed be volatile, and we just don't know.
Yeah.
Yeah.
Well, Fools, this has been a fun hour. I think we have Seth and maybe Jeremy coming up. Danny, anything else you got real quick as they come on, or?
The only thing that I saw in here, there was a quick note from Besties in here. Danny, I also added to the Trade Desk ticker TTD 2 reports ago when it dropped. However, this time I'm not so sure to add on the drop despite the larger drop. I personally, I'm willing to give CEO Jeff Green the benefit of the doubt because he has an amazing track record of running this company to the benefit of shareholders. And if you look, he probably owns a larger percentage of the company than any other individual shareholder. So yeah, he's got a vested interest in making sure that it works.
I'll go further as someone, and this is, I was told I don't own tech stocks, but I do own this one. And I do think that, I love the whole, founder CEO thing. And I get why we look for that. But a lot of times the skill sets change. It's much different than if it's Danny, myself, and a couple of the people in rented office space with an idea versus a huge multi-billion-dollar corporation. All right. That is just a different thing to run. And not all CEOs are like great at both, right? Or can do it all themselves. What I love about Jeff Green on this is like, yeah, dude, we got too big for our structure. We should have seen this coming. We really screwed this up. And 1, 2, 3, 4, here's how we're going to change it. And as an investor, I really like that. Just understanding that, again, I want a CEO who will say, this is on me, and here's how we're going to change it. The warning is that what they said they were going to do will take multiple quarters. So I don't know how quick the bounce back will be. Then again, I think expectations are down. So maybe it's easier to get that crazy boost next time. But yeah, long term, I really like all companies stub their toes. It's the thing to focus on is what the CEO says afterwards or what the company does afterwards. And I really liked it then. And I think with that, we're ready for Seth and Jeremy to join. Yes, gentlemen, how you doing?
Hey.
Pretty good.
You guys were talking about moves after earnings. I always used to say to people, like, if you told me the earnings, I don't think I could get the move right. Like,
yeah,
I still think I'd lose. Unless there's something super obvious, like
well,
Wong, like goes to another country and retires or something. like you don't know, and you don't know whether it'll be big or small. I literally could, if you gave me the insider information 12 hours before, I would not be able to make profits off it.
To that point, I mean, one of the things I do for the Fool is some of these big company earnings when they come out to try and like look at it real quick. And a lot of times, I'll just Google them and the hardest part of that job is, all right, it's down 7%. Why? Like I just looked at all the numbers and but a lot of it too is just kind of, it's so thin in the aftermarket too, even with the big stocks. But
and then
there are
even in
more
the real
important
market,
things to focus on.
Yeah, like
Period.
the why is very often, it's headline writers sitting around having to make something up because you often don't know. It's a stock.
That is, and
that's
actually,
why.
Seth, you're the perfect person because you could probably program this up. One of these days, I wanted to make a Twitter bot that at 4 p.m. Eastern every day just said the Dow Jones falls or up or down, and then just take the top headline from Yahoo Entertainment and fill that in. So it's like
I
the
used to do
Dow's
those
up
as a
on
joke.
Selena Gomez's new dress,
I
or
used to
something
write-
like that.
I used to write those as a joke once in a while. Exactly.
Yeah. Okay, on that note, we will let you go and talk about far more important things, but have a great show, guys.
See you.
Thanks.
Peace, Fools.
Jeremy, we haven't done one of these together. So
No, I know.
Cool.
Good to see you.
Awesome. Good to see you. We have some questions in the queue. Some of them, looks like they handled a lot of them. So I thought we would talk about some other kinds of stuff. There was something interesting. Well, this morning we had a lot of consumer confidence information, inflation worries, and so forth. But a company I hadn't heard from in years, or even heard of, because it had been so long since I was aware. Contour Brands, you know them? Maker of Lee and Wrangler, right?
That does ring a bell. Yeah. That was the one that split off from VF Corp, right? A few years ago.
Does that make sense? 2018 founded, but obviously Lee and Wrangler have been around a lot longer than that. So earnings and then commentary this morning from the CEO saying that their consumer is feeling attacked, was the word, which I found interesting. Their consumer is probably going to skew more sort of rural, middle America, South, I would guess, just because that's where those jeans sell. So interesting to see that that they're seeing their consumer feel under pressure, because a lot of the recent consumer confidence numbers tend to be sort of split by political affiliation. Well, the numbers this morning seem to suggest a little bit more of a broad worry. And then we also had, so this is a topic, if people want to ask about this kind of stuff, I think it would be an interesting topic to open up, because we also had recent earnings from Home Depot. And they said, well, we're doing a little better, but things aren't great. We expect things to be a little better, but they weren't that great. Comps were up, but like 1%, which is, depending on price action taken, may not even be an increase, really, right?
Yeah. Relative to where they were. I mean, the stock was up on a day when, almost everything's down. So, relative to where they were, I think it's a good report for them. They'd had several quarters of declining comps, but I wouldn't say it was, particularly strong forecast for 2025 kind of things. We expect things to continue as they've been.
And then we got news this morning or last night, whichever was it, which was that, okay, the tariffs on Canada and Mexico are coming. Who knows if that's true, but it's yet another they are coming thing. So it's important to remember for the likes of Home Depot or many of their suppliers who would be located in Mexico if it's stuff like hardware, China if it's stuff like hardware, Canada if it's softwood lumber coming in, then having value add at U.S. suppliers and then flowing through to Home Depot. And you're looking at 25% still on Canada and Mexico on all goods except for, I think, Canadian petroleum was the one exception made so far. And so that will definitely have an effect on a lot of spending. Home Depot sells an awful lot of wood product. And again, if 25% of the lumber coming into the U.S. is coming from Canada, you can expect those prices to move. And with unknown effects. If consumers are already hesitant, not spending on the big ticket items, then maybe they lay off doing some of that home improvement. So it'll be interesting to see what happens over the next few quarters, if that happens, if that unfolds.
Yeah, definitely. I mean, interest rates are always, they're already still high. So it's been a tough time for the home improvement sector or prospective home buyers as well. So higher lumber prices was definitely not going to help that.
None of it seems as bad as like during COVID when, I went to get a piece of plywood and I went, you want $80 for a sheet of plywood? Like what planet do you live on? And because there was none and the people who really needed it would pay $80 a sheet. So nothing looks as crazy as that. But it's a large portion of the cost of homes that the home builders are putting up. And I saw that they, on their website the other day, so like last week, I think it was, the home builder index was kind of not so great. And definitely tariffs are going to increase the costs to them as well going forward. I think they're probably a little bit better able to pass some of that along. But again, like the 10-year notes, the yield was up a little bit today on some of these consumer confidence and inflation concerns. And so, of course, for the folks out there who aren't familiar, mortgage rates follow 10-year notes, not the Fed really in lockstep. And so when the yield goes up on those, then mortgage rates are a little pricier too. So we don't see any relief there soon.
Yeah, Treasury yields have not, if you were hoping that, I think a lot of us were hoping that the Fed rate cuts would flow through to mortgages and other parts of the market, but we haven't seen that happen. As you noted, Treasury yields have kind of gone the other way over the last 5 months or so. So
so it has been tough. Now, some of us who got mortgages for like 8-9%, years and years ago, today still looks not terrible. But a lot of us geezers may have refinanced our homes at like 3% or less a few years ago. So compared to that, these rates are really difficult. So we have some questions in the queue. I don't know if you're more familiar with some of these companies than I am. Axon, Celsius, a little bit off my radar. What about yours?
Yeah, I could take this one on Celsius. It's been a hot topic on here. Definitely a stock that's moved around a lot over the last really any time frame. Soared for a few years from 2020 to 2023 was a real. This is Celsius' energy drink company. CellH is the ticker for those of you who don't know it. Ed asks your opinion on CellH, buy, hold, or sell. The company kind of came out of nowhere during the pandemic and really caught fire on Amazon, and has since it's sort of widely available in stores. They signed a distribution deal with Pepsi. Pepsi is a minority shareholder now, and they kind of hit a wall last year. Few different problems they've been facing. First, Pepsi kind of overstocked their inventory of Celsius, so they cut back their orders, which hurt Celsius's revenue. The company has also been complaining about more Celsius. Their motto is "Live Fit." They're kind of, they have a healthy brand, I guess. They say they started in the gym. That sort of thing. So there's a sugar-free product. You can debate whether an energy drink can be healthy or not.
I'll try not to rant too much when it's my turn.
Yeah. But so now they're facing more competition from other sugar-free products from Monster and Red Bull and some of the smaller companies. So that's eaten into their growth. So what's happened in the last few quarters is revenue has actually declined because of the Pepsi issue I mentioned with the inventory, and then even their retail level sales have gone from pretty strong double digits to just 2% in the U.S. In the fourth quarter. So I saw the stock was down today. I don't know if there was specific news. I think it really it's emerged as a battleground stock. They just announced the acquisition of Alani Nu for $1.8 billion. So Celsius is the number 3 energy drink company now in the U.S. Alani Nu is the number 4 energy drink company. Alani focuses on female, customer base, sort of female-oriented brand. They do snacks and shakes as well, in addition to energy drinks, growing very fast. And they sort of have the same kind of, healthier energy drink kind of brand. So I think that acquisition makes sense for them. Gives some upside to the stock, but I'm concerned about the sort of structural slowdown in that competition. So I mean, if I had to rate them right now, I rate them a hold. I understand why it gets a lot of attention though, because the stock is down, maybe 75% from its peak. So it feels like one of those that, like, okay, well, if the growth comes back, maybe you can get back up there. But I don't know. I'd be more cautious than that personally.
Yeah. So this is a company I never got as an investment, and I never liked the product for various reasons. One is which, like, the whole idea of an energy drink is nonsense, especially if it's sugar free, because caffeine, of course, is not energy. Sugar actually has energy in it. Caffeine doesn't. Caffeine just zips your heart rate forward, right? And the other, so years ago, I mean, there's just been there's kind of a constant flow of new I'm going to just call them caffeine sellers over the years. Like Red Bull was the first one we probably remember in terms of beverages. But before that, you could just get caffeine pills at the gas station, at the truck stop, right? You get 100 milligram caffeine pills to stay up when you were driving your car. And Red Bull was originally, unless I'm hallucinating the history of the company, the guy who founded it based it on, if not directly patterned it on, energy drinks, quote unquote, that were sold in Asia that taxi drivers were quaffing while he was being driven around. And so everything is sort of followed on that. And so it's the illusion of energy that you get from these things when you're hopped up on caffeine. And Celsius, had kind of a gym rat origin story, to the point that actually the state of Virginia, where I live, has actually had to ban these things for kids, because kids are slamming these things before athletic events, and it's highly dangerous. I forget how much is in a Celsius, but that little can, I believe, has 230 milligrams of caffeine in it. And it's about as much as is in a very large cup of coffee, except you can slam a couple of them really quickly. So aside with having just an issue with the alleged health benefits of this stuff, which I think are the opposite of true, and if throwing in a few vitamins, I don't think actually makes it healthy either, is just an easy roadmap to follow, right? All you need to do is to generate some buzz and then throw a bunch of caffeine and try and sell a healthy vibe, right? And not everyone's going to guarantee success, but there's no super magic sauce here. It's all one fashion or another. And so that's the problem. I mean, Monster was like the huge stock for years before this, right? Everybody wanted to have a piece of that. This one came along. So my view of all of these companies over the long term is there's no real moat besides the brand, and brands themselves can be the most durable kind of moat possible. So I don't want to say that Celsius is doomed because the brand is doomed. I don't mean that, but I mean that durable brands are worth a ton, but they're very special and they don't happen all that often. Like Coca-Cola, Pepsi, some of these brands that have been around forever, they're the exceptions, right? I've got bottles on a shelf downstairs where I used to dig up an old dump that was from like the 1920s on an island where we had a cabin when I was a kid. You wouldn't believe and these were energy drinks, by the way. They were tonics, but they were all energy drinks. They were locally produced, locally bottled. Like, I've got bottles from these companies from 100 years ago sitting on a shelf. This is an old story. Patent medicine, it's the same thing. Some of these things have lasting durability, lasting power, and they become incredibly value producing over the long term. But the vast majority of them don't. And so that's why I'm never really all that excited about this kind of stock. I saw this one when it happened. I had seen Monster, but I was not tempted to get on board this one either, because history tends to repeat itself with these kinds of products. So others may disagree, but I'm personally, as an investor, this is not my kind of investment almost ever.
Yeah, I wanted to note also, I mean, we're seeing some maturity finally in the energy drink market. More generally, I think, Monster was a great stock for years, as you mentioned, but their growth, their revenue growth has started to slow as well. So I think that energy drinks have sort of gone from more of maybe a high growth market 10 years or so ago to a pretty mature market now.
Yeah. And as I've said on many of these, like, you can lose money on a company that does even a good job financially. And so, for example, I'm thinking of, what's the beverage company? Fizz was the ticker that was selling the waters, the fizzy waters that were all the rage. LaCroix. It was selling LaCroix.
Right.
Is it National Beverage? I even wrecked it once I'm getting old. I can't remember things. But anyway, I remember being really stunned because I grew up with LaCroix when I was a kid, and suddenly for it to be trendy was absolutely insane to me. But it was a company that produced a good amount of free cash flow, would save up that money, do stock buybacks, run by a pretty wacky CEO who owned a lot of it for a long time.
Yeah.
But at least there, the trend was backed up by some pretty solid financials. And so I was okay with that company, and it didn't do great. So, but when I look at Celsius, like, the free cash flow just isn't there and isn't so great for a company that is essentially selling some really inexpensive chemicals mixed with water and then thrown into aluminum cans. So if a company doing that isn't producing some good free cash flow or earnings, even in a growth mode, I tend to be a little bit worried, because again, this is not really rocket science. This is stuff in a can. So that's just the way I look at a lot of these companies. I don't want to be burned on trends.
Yeah, that's very true. See any year you like?
Well, I don't know Axon that well. I only have stories from back in the day when they were Taser, when they were super popular in the early 04s and stuff. And like, quite literally, I'd be on my way home, walking home from the bus stop, having written an article where I said not such flattering things about Taser, but even worse things about the companies back then. There were some scam companies trying to pretend to be Taser, and the CEO would call me on the phone to tell me that he appreciated what I said about the competition, but that I hadn't really been sufficiently generous to them. But I know Axon they got hit the other day, but I don't follow them enough to have an opinion on what's going on with earnings.
Yeah, Axon. Yeah, I saw what happened last week. There was some split with key partner. Can't remember the name. Let me see if I can find it. But yeah, the stock was expensive, and it really fell off a cliff after that. Got hit with analyst downgrades and that sort of thing. Oh yeah, Flock Safety. That is sort of, I guess their partnership has went from a sort of partner to now competitor. Axon is actually my biggest holding now. I've had, owned it for a while, and it's done very well. I've been really impressed with their innovation, and I think as far as it's not a company you hear a lot about as far as a technology company, but some of the things they're doing, they're one of their new products, Draft One, is this AI thing. So Axon is law enforcement tech. They make tasers, as Seth noted, and body cameras as well. And then they have a lot of cloud software that sort of goes to help police manage records and evidence and that sort of thing. But I thought this Draft One thing sounded pretty cool, that they have this AI tool that will just automatically converts footage from body cameras into a police, or an initial draft of a police report, which seems just pretty amazing from a technological perspective, but also useful time saver. So they keep pushing the envelope as far as innovation, and they really I think they've let past any kind of reasonable competitor in that field. I don't know what it's hard, it's hard to predict individual earnings report, but I think given their track record, that for me is the kind of stock where, a buy the dip kind of stock. So we'll see what happens tonight. It's still expensive, but
it's dropped from like 700 to below 500 over just like the past couple of weeks. I haven't looked at their financials for a while. So this is a company that is a growth company that I wouldn't, sneer at so much. It looks expensive, but, consistent production of free cash flow over years, slightly more profitable on free cash flow basis lately, even though gross margins have trended downward slightly. So obviously doing something right. Like you said, you can't really predict what's going to happen. Like we open the hour, even if we had a copy of the earnings, we might not be able to make the bet right on what the stock will do. But it's one I'd be more interested in than many others out there, just based on, actual free cash flows and some, like software that takes the hassle out of turning that video into police reports. That's something nobody who uses that stuff is going to say, no, we don't want to pay the extra price per month for that, right? Like who would refuse that? Nobody.
Right. Yeah, it definitely seems like one of those, doing what your customers want you to do.
Yeah. Oh, here's an interesting one that will probably spin out of control for the two of us. Can you give an example, Seth, Bestie's asked, of a business that has a moat in your sense of the word? So yeah, I can give a few, and they will be moats of various, to mix metaphors, durability. We talk about moats being deep or wide and deep. Anyway, durable competitive advantages. I said brands could be one, right? Coca-Cola is still a huge brand. It's, attacked from everywhere. So energy drinks here, healthier beverages over here, even when they're not healthy, just plain fizzy water over here, generics and so on, but still like giant mind share. The brand itself is worth zillions and zillions of dollars. So a brand like that is a really good moat. A brand like Apple is a really great moat. Their phone sales lately have been meh, but the brand itself is worth so much because of the loyalty it inspires in buyers. So a moat is a brand when it's a good one is a weird intangible moat. Who was it? Was it Buffett or Munger who said, like, the idea that you're gonna, like, Wrigley's, this was back in the day when people still knew what Wrigley's gum was, but you weren't going to put the cheaper gum in your mouth because your mouth is an awfully personal space, so you're going to pay up the extra 5 cents for the Wrigley's, was the point. So that's one type of moat. Moats in terms of industries that aren't brand based can disappear more quickly, but there are a few examples of some that I think we could both come up with, like ASML, right? Selling these lithography machines that nobody else in the world can make them, that do the same things that they do. So these are the machines that go into the foundries that make all the highest end computer chips, and there's literally no other place to buy these. So that is an example of an amazing and durable moat. Doesn't mean the stock always goes straight up. These machines do they cost as much as a 747 now? I think they do. They take up like 2 747s when they have to ship them and put them together.
Right.
But that's an example of an extremely, that's a kind of moat we may never see again, right? It's tough to imagine any company having a competitive advantage like that. What are the ones that come to mind for you, Jeremy?
I think network effects is a good one. You think of a company like Meta, or so the social media platforms, Facebook and Instagram. There aren't a lot of those properties, apps, businesses, whatever you want to call them, that have that kind of scale. And that, occasionally a new one comes along like TikTok or something. But if you have, 2 billion users on your app, that's going to make it pretty powerful. It's going to incentivize new users. It's going to make it harder to, for new entrants, establishes barriers to entry. Airbnb is an example of that as well. If you're going to go, you want to, share your home, rent out your home. Maybe there's an advantage to Vrbo. I know Vrbo is kind of trying to carve out their own brand, but Airbnb is the biggest, probably gets the most traffic. you're probably going to go on Airbnb. So I think,
Yeah.
network effects is a good source of competitive advantage or moat.
Yeah. And what's funny is I'd known about Vrbo like for years before Airbnb was even on most people's radar, or even before Airbnb was kind of doing what Airbnb is known for then. Like when I first heard of it, it was still like this weird place where you stayed in someone's room and it was kind of skeegy. That's like my first memory of it. And then it kind of morphed into something else. So those are a couple of kinds of interesting moats. And there's another one I want to mention just because it's like an old school one and it's counterintuitive. And I have a hard time thinking of a contemporary company that fits this mold, but it comes from Peter Lynch when he talked about in the old days, he said, a company that's the last surviving paper cup maker in a region actually has an interesting moat because the business is so low margin and it's fairly capital intensive. Like what idiot would try to say, well, I'm going to open my own paper cup company and take away the last of their business? Like, almost nobody would. So sometimes you can find moats in kind of like orphan industries where there's the kind of the last company standing. And you might think of some of the vinyl record manufacturers that way right now, possibly. By the way, I've invested in those companies before and gotten it wrong. I invested in somebody that was like one of the last CD manufacturers standing, and it didn't go well, even though they were the last one standing. So you can get that wrong as well.
It's a good lesson, I think.
Yeah, there's several questions here sort of asking for stocks that we would buy or add. I tend not to do that on these personally. I don't know where you are on that, Jeremy. So now that we're like on YouTube, if we're talking, we don't want to really be talking about stock picks that folks have paid for, also streaming it free to YouTube. And so I tend to keep that kind of stuff within the services where I'm doing the work. So we're happy to talk about the companies, but as far as like making recommendations, I'm not going to be doing that. Might have to zip down the list here and see what we got.
I like this. What are examples of GARP growth at a reasonable price in this market?
Yeah,
it's. I mean, I do agree that it's not so easy to find that anymore. I mean, I think this isn't a secret by now, certainly, but I continue to be surprised that the semiconductor sector, I think, is still, if you look at it by traditional valuation metrics, PE and that sort of thing, a company like Taiwan Semi, for the what we're seeing from the current growth rate, I mean, a lot of these stocks are pretty well priced. Broadcom, Micron is very cheap. So I think that sector is sort of, I mean, somewhat surprisingly maybe, but offers more value than you might expect.
Yeah, the rub is always that like some of the growth looks great even if it's low, but if it's cyclical and you get into that cycle, then suddenly everything goes wrong.
There's a risk there.
Yeah, and so it's fair to ask, like, well, is our I had a discussion with my colleagues earlier today about this, like, are semiconductors even cyclical anymore? Like certain parts of that market haven't had a down cycle forever. Like, like GPU processing and stuff like that's been going gangbusters for years and years and years. And it kind of lulls us into the sense that, well, maybe there's no cyclicality there anymore. And so I tend not to believe that's true. I tend to believe there's a cycle coming all the time at some point, but we haven't seen it yet, and it's really tough to figure out when it will be. On the other hand, if you look at certain segments within semiconductors, like phones or kind of RAM memory or lower end memory, that stuff has continued to be a little more cyclical. And so to the extent that like Taiwan Semiconductor is playing, in a market where they, you look at their pie charts and their quarterlies, you know, if this is -5 and this is -3 and this is -2, but high performance computing is +15 or +35 or whatever it is, then the growth continues. If high performance computing ever goes to only +5 and the rest of those are hurting, then the growth at the reasonable price starts to look like stagnation at a price that's no longer reasonable. And that is always the trick. And one of the toughest things to do in investing is find the companies that are kind of continuing to grow and that aren't really so subject to the cycles. And so at the beginning of the hour, we talked a little bit about, you know, consumer confidence, and inflation expectations. Well, by one measure, I saw in one of the commentaries this morning, nobody's used the R word, the recession word, for months that I can imagine. It was all the rage like 2 years ago and a year ago. Everyone just kept predicting recessions, and everyone was so confident there would be one that I was pretty sure there wouldn't be, just because everybody had the same exact thought. And now we kind of seem to be on the opposite side, where nobody's thinking there could possibly potentially be a recession. Meanwhile, consumer confidence is kind of edging down in what looks like a little scary fashion. So I'm not predicting a recession, but if there were one upcoming, it wouldn't surprise me. It would surprise me less than it would have over the past couple of years. And that's where the growth at a reasonable price turns, like I said, into the not as much growth. I'm going to look up one company here because just because it's often at a reasonable price, but not always. So, and I'm going to decide if this one fits as GARP for me now. You're familiar with Decker's Outdoor, right?
Oh yeah. Yeah. That's a good one.
Of course. So as you know, UGG forever was super hot, and then it just lagged forever. And then Deckers bought Hoka when Hoka was almost nothing. Hoka is a running shoe company. I was very early into Hokas because I was running like a marathon every 3 weeks or something. And I was running some ultras, and I knew the folks in that world, and ultra runners were starting to run in Hokas, and they were crazy, and everyone thought they were nuts. But Hoka was selling a ton of shoes. And so when Deckers bought Hoka was little. I think they were only selling like 30-40 million bucks worth of shoes a year.
I didn't realize Deckers bought them.
Yeah, so they've owned them for quite a while, and Hoka is now like the biggest growth engine there still.
Yeah, yeah. I know they own them. I just thought it was
Yeah, no, they didn't. In fact, that the Deckers has been super great at buying small established niches and then like incubating them and making them awesome. And I really never thought Hoka would get as big as it did. I bought it for a service years ago. And Hoka was doing pretty well, but it actually wasn't doing well enough at the time to offset the sluggishness of UGG at the time. And so I ended up selling it, which, you know, it would have been like a 5-bagger from here if I hadn't been dissuaded by UGG. Now I'm seeing here that Deckers has gone from like 215 bucks down, south of 140, trading at a free cash flow yield of 5.2%. They make actual cash flow. Their gross margins have been going up forever. They stand at like 57.8%. Operating margin, the same, almost no debt, 9 times as much cash as debt, 23 times current earnings. That is going to be what I would call growth at a reasonable price, just off the top of my head, because they managed to keep selling more and more of those Hokas. And Hokas are interesting because they're a little bit fashionable, but they also, unlike say On, I'm thinking of as a competitor. On is a very hot shoe right now. But the other day, my daughter and I were up for a 6-mile long run. We were on the running trail by my house, and I just started looking, and I'm not kidding you, like 8 out of 10 runners on the trail were not only wearing Hokas, they were wearing the Hoka Bondi, which is just a boring running shoe that I wear. And I couldn't believe it. And I was looking around for other brands, and there weren't a lot, a smattering of Nikes and stuff. But Hoka has the street cred still with running, which is an enormous market. This is, if you listen to Nike's earnings calls, they lost this market, and they're desperately trying to get it back. On is a what I would call growth at probably less reasonable price, selling lots of running shoes. But this, I don't mean to sound as flip as it does, but my experience, and I go to track meets like once a week and see what the kids are wearing and the adults are wearing. Like I see On running shoes at my ophthalmic or my optometrist's office or at the orthodontist's office. I see Hoka's on people who run. So to me, it's a different market. To me, the running market is a little more durable market. And so they've got UGG, they've got Hoka. One of the things I hate about Hoka and Deckers as a consumer is that their inventory control is way too good. I can almost never get anything on sale. Great for the investor, great for the company, terrible for cheapskates like me. So that is a long way of saying Decker looks like a good GARP stock to me.
Yeah, maybe I'll throw in one more too. That's well, growing on the bottom line. I want to say Williams-Sonoma. Like a lot of the home. We talked about Home Depot before. I mean, a lot of those home focused, home improvement, home furnishing businesses struggle, but Williams-Sonoma as a stock has done very well in the last couple of years. Very well managed company. They've kind of continue to grow the bottom line, even as comparable sales are down. Management is sort of done a few things. They've limited discounts, sort of ensuring that they sell at full price, so that can hurt your top line a bit. But if you're growing profits, you're doing the right thing. They're building sort of more of a marketplace business, tapping into the trades more, so growing new revenue streams. They're buying back stock pretty rapidly. So I think it's if you're looking for top line growth, they're not doing it right now. But I do think the kind of company that I think eventually we're going to see a healthier housing market and home furnishing demand and that sort of thing. And I think Williams-Sonoma, great set of brands. It's not Williams-Sonoma Pottery Barn and West Elm, so I think they have that kind of higher end niche pretty well covered. That's definitely a stock that I think fits into that kind of GARP category over the long term. Certainly, I think they're a good bet to keep growing their dividend and deliver solid long-term growth.
Yeah. So because we were talking about brand, and because we were talking about shoes, because we were talking about growth at a reasonable price, and because I mentioned Nike, I wanted to pop open the old spreadsheet here and talk a little bit about Nike as a not growth right now at a price that maybe is more reasonable, but still maybe not quite cheap enough. So anybody who's been following or who hasn't been following has seen that Nike's revenue really started to flatline in 2023 and then has been dribbling downwards from here. And we're talking about revenue, like a top line annually that was up in like the $51 billion range, dribbled down to like 49 billion over the trailing 12 months. And the stock, which peaked at like $160 a share in February or somewhere in the middle, not the middle of 2021, now trading about $80 a share, a little bit lower recently. And Nike is an interesting example of kind of blowing your brand and not using it well, but still having a strong enough brand to be able to probably mount a comeback. And so what Nike did lead into during COVID was way too much online selling and far too much emphasis on just like fashionable sneaks. And they lost sight of kind of their DNA, which had always been a little bit fashion after they became popular, but also, making sure that the performance end of the business was really, hauling the mail, writing the checks, getting it done so that you can have street cred with the fashionability side. And part of that for a long time at Nike, everyone thinks about basketball and Nike does okay there, but they kind of lost it in running in a lot of ways. And at the same time, because they were so focused on online sales, they somehow forgot that most people really want to buy their shoes, especially something like a performance shoe, like a running shoe. They want to try it on in the store. So they started to shed relationships with some of their longtime partners. And even those that they didn't get rid of, they didn't send them enough product. And so this really blew Nike apart over the last couple of years. And they've got their new CEO is a veteran who's back in charge, and he wants to repair those vendor issues, get back into running. So Nike is one to keep an eye on. I haven't purchased any yet, even though I've been kind of looking at it for the past probably 9 months or so. I still haven't rung the bell yet, as they say. Right now trades for like a 4% free cash flow yield, and Nike makes pretty consistent free cash flow. That's not quite enough to get me interested when the top line is still headed downwards. So I think, I'm more interested if the stock price comes down a little bit more. Over the long term, Nike's return on invested capital tends to be like 12 percentage points above their weighted average cost of capital. So over the years, Nike tends, even when they're screwing up, they tend not to be screwing up that badly. And Nike, if you watch the Olympics this summer, or say you go to a track meet like I do, Nike still has amazing street cred in high-end running. Like you go to a track meet, almost every spike that the runners are wearing is going to be a Nike track spike. Same thing at a cross-country meet. They are just considered the best, and they have some technology that actually puts them in that place. It's not just reputation, and it's not just fad. They did some things in running that nobody did, and it's kind of sad because Nike kind of rewrote the book on distance running shoes starting in like 2015, at the same time that they started to lose the running market. So the high-end running market now is dominated by what's called a super shoe. And basically Nike didn't invent this foam. A company called Zote Foams had licensed it from a different company and said, listen, this foam is a way better spring. Put it in your shoes. And Nike was like, well, it's really squishy. So they put a carbon fiber plate in it to manage the squish. And it became what's the Vaporfly and the Alpha Fly. And it's this shoe that took like minutes, literally minutes off the world's best marathoners' times. I mean, it had to be responded to by all the other shoe companies. So all the other shoe companies eventually did respond, but Nike still pushes the envelope on performance like that. And they still could get that street cred back. They're not there yet. So that's one to look at, because if that downward revenue curve starts to inflect back upwards, they're probably going to be growth at a reasonable price.
Yeah, definitely be interesting to see what happens with Nike. I think they'll recover over the long term, but could be a long road for them.
Yeah. When I go out here, so some of this again will depend on where you live. If you live in a fancier neighborhood, you probably don't see a lot of Nikes on people's feet. They're wearing other shoes. I live in a neighborhood that's like runners, and then, lower rent people like me, and I still see a lot of Nikes out there, just people walking around.
Yeah, still a huge business. It's kind of an
interesting question. Is that the one you're looking at on top?
Yeah, that just came in. Yeah, Sanjay JC says, question for tech savvy host: is the idea of hidden gems anachronistic since AI mines even the most obscure company filings? Will anything be hidden? I think this is a good question. I mean, I think in the stock market, there's numbers which are known, pretty much immediately when they're released. But then there's that, really, I think that the key to finding hidden gems is the story. You want to find a company, that's sort of just starting to pivot or just starting to break out before the market recognizes it. I mean, one company I think is a good example, looking back a few years, is AppLovin, which has sort of morphed from a mobile game developer to an ad tech company. So they started out with mobile games. They kind of launched an ad buying platform or ad tech platform on top of that. and it's grown like wildfire. And now they're just selling off the mobile game business. So it's just going to be entirely an ad tech company. So I think, I mean, you know, internally, it's probably an easy thing to see maybe earlier on, or, you know, if you're, you know, deep in the weeds in that kind of industry. But to me, that feels like a sort of good, you know, hidden gem kind of stock if you were able to recognize that. But I think as far as finding hidden gems, which I think maybe is something a newsletter you've worked on, Seth. I mean, I think that's what you're trying to do that. So I don't think AI can really do that.
Yeah. So I was the longest running, this is old school hidden gems, the longest running hidden gems advisor in its existence till it closed after I came on. After Tom had moved on from it, I took his slot. And even then, so this is going back quite a while ago, I didn't believe in the concept of a hidden gem because the numbers were all out and the filings were all available to anyone online, and investing shops could sort through this stuff even years ago before LLMs. They could, and even before machine learning, they could sort through this stuff so well that nothing was really hidden, right? So the hidden gems, I believe, is an anachronistic term. It comes from way, way back in like Lynch or before. Nothing's really hidden at all and hasn't been for 2 decades minimum. That doesn't mean you can't find hidden opportunities, but the opportunities are hidden not because people don't have the data to see them. It's that they see the data and they don't like it. So it's really more of a hated gems kind of a situation, in my opinion, or not yet appreciated enough gems situation, kind of like the one you mentioned. So there may be a company that in the old days, you could still maybe find a growth company that didn't have enough coverage. So it wasn't hidden, but not a lot of people knew about it. And so you still might be able to get into that before it was super popular, but nowadays things become super popular right away. So I think even now you're probably even more reliant on something making like a pivot, like you're talking about, like slightly changing the business in a way that a lot of people aren't really going to understand until the numbers begin to show it later. And I can think of, you know, some other pivots I've read about recently, not from publicly traded companies over here, but from some Asian companies that were panel makers who are now pivoting to doing other things in the semiconductor supply chain because they just got so good at some of the stuff they were doing in panels. And when panels started to become really low margin and not worth it, they took the tech they developed, tweaked it, and started selling that into other markets. So those are the kind of opportunities I think we identify nowadays more as hidden gems. But certainly, yeah, the notion is a little bit anachronistic. Everyone can get the data if they need it. It's kind of what you make of it that matters. And I use LLMs all day, every day. I still don't think they can examine a filing and give you a reliable read on what's going on in there. And I say that because, like, not only have I done that, but like I use LLMs for programming, including Google AI Studio, which has a huge context window, and it's super great at like finding a section of code and fixing like a silly error in there or rewriting it to do the math differently or something. But it's really bad at keeping the context from the entire chain of thought or understanding even just a slight nuance on the structure. And so if it can't do it for code, which is one of the more optimized examples of what these are good at, I don't think it's going to find, you know, sort of the nuances in business moves. That's not to say I couldn't call them out. It could call them out and say, hey, here's, you know, what management's saying here, here, here. But as far as judging whether those are really opportunities, for now, that's human. That takes meat bags like us, I think.
Yeah. Like this question from Shimon a little while ago: which stocks would be the best to purchase during recession? But I think there are two ways to interpret this. First is if we're actually in a recession and stocks have already sold off, like say where we were in 2022 or the end of 2022, which wasn't a recession, but a bear market at least. I think in that kind of environment, you want to buy beaten down growth stocks. That I think that could include, certainly your marquee kind of magnificent seven names, Amazon or Alphabet or, those kind of stocks, pretty good bet that they're going to recover. But then you also might see a stock like On, that you'd mentioned, or, a growth stock that is doing well, and then is down sharply because, well, hey, consumers just aren't spending as much money as they were, investors are nervous, that sort of thing. But, I don't think a strong consumer brand, like I don't follow On that closely, but just using it as an example, that's going to really derail that. Or say a restaurant like Kava, I would look towards something like that.
Yeah, it kind of depends whether you mean before the recession or during the recession when the prices have already adjusted. If you're looking for what to buy before the recession, there really are no, in a recession, just about all the stock prices go down. So there's really no safe haven. So if you have your crystal ball working appropriately, let's talk afterwards. Because if you really knew, you would be buying puts or something like that. So I agree that in a recession, if stocks are a bear market when lots of things have been beaten down, in a recession, you probably need to be a little more careful, right? And just a bear market where the economy is doing okay, it might be a little bit easier because you're not possibly trying to gauge, changes in revenue or profitability or something. You're more just looking at, okay, everyone's freaking out, the price is down. In a recession, you're dealing with not only that potentially, but the very, plausible reality that the revenue line is going to be down and therefore they're going to delever and, margins are going to go bad and everything else. So at that point, the typical advice is find your best ideas and figure out which ones you like the best and which ones have been beaten up the most and start buying those. And the advice I gave over and over remember in COVID for a while when it was really bad and everyone thought you shouldn't buy any stocks and people were really freaking out. I said, you can go ahead and just transaction costs are almost free, or they are free. You can buy $100 worth of your favorite stocks once a week, buy 5 of those, and then do it next week. Desensitize yourself to that dollar cost average. That's what I did. That's what I advocated people do if they were interested. And sort of getting over the paralysis and dealing with this. There's you don't have to wait around and take the big swings. If you're kind of an everyday investor like we are, and your shopping list doesn't need to be different than your shopping list today. It can be the same stocks at better prices.
Yeah. I would say to add to that, I mean, if you're worried about a recession, I would, like you said, Seth, I mean, pretty much everything goes down in a recession, but I would maybe park some money in, safe dividend yielding stocks, something like a Realty Income, which is a, REIT that lends to, leases to kind of boring chains like 7-Eleven, Walgreens and stuff, or, utility even, maybe a health insurer, something that's going to be less or not very disrupted by what's happening in the economy.
Yeah. And we're not giving direct advice to anybody on what to do, but we're just saying if this is what you're thinking, these are options, right? Personally, if I'm worried about that kind of thing, I park the stuff in savings accounts. And I worry about it occasionally. And sometimes I'm much more overweight in cash than other people. I grew up with not a ton of money. I still remember, when I was married, my wife and I were just getting started. I remember 2-digit bank account, before the decimal point. I remember 2-digit bank account balances in the checkbook. And I think people like us are probably more risk averse. I always like to say, maybe I'm wrong about this, but I feel like it's a lot easier to take on investing risk if you have a lot of money. So, like if you can invest 20, 30, $40,000 in a risky stock, and if it blows up, it doesn't really change your standard of living at all or your future. It's a lot easier to do that than if that represents like, oh my God, I just really blew it sort of money. So a lot of this depends on financial situation that only you can address for yourself, right? Risk tolerance. How old are you? How much money have you got saved up?
Yeah, everybody's circumstances are a little different. We got 2 minutes left. Maybe I'll hit this one at the top here.
Sure.
Steve says consumer could be softening impact on Shopify. I mean, if we're seeing consumer demand going down, I mean, that's not going to be good for pretty much any retailer or e-commerce related company. Shopify, I think most of their sales are going to be coming from discretionary goods, rather that's sort of mom and pop online sellers on the platform or larger companies. And the stock is expensive, so I think there is a risk there in the near term to the extent that it's hard to say right now if we're seeing a sustained pullback in consumer spending. Right now these are really just sentiment numbers. But I don't think if this is something that's affecting Shopify long term. I don't think it's going to change their competitive position. It's not going to make them less attractive to new merchants. So I don't really think it's a structural challenge for them. So
impact on business, probably nothing except for a change in numbers. Impact on stock price could be a whole bunch. It would all depend. Part of the textbook answer probably that people may have been looking for is that, in a time of recession, like consumer staples are supposed to do better. So like groceries, things like that, stuff that people don't have as much ability to avoid entirely. And then there's also the idea, like, if you were doing that, you might say like, Whole Foods, they sell consumer staples. But you know what? People might trade down to Walmart instead of Whole Foods because Walmart's got better prices, or Aldi or something like that. Again, all the lowering tide lowers all the boats, but some of those companies like consumer staples are going to be less volatile, and then consumer discretionary stuff that is going to be sold on Shopify or Etsy probably more at risk if people decide to tighten their wallets. And if people are buying fewer Wranglers and Lees right now, maybe we are on the cusp of something a little scary. We haven't seen anything like that for years. It does happen, right? It's not just tech stocks that go down.
No. Danny, you're back.
And Danny, you're back.
Hey guys.
I am back.
I like to think that Danny was sitting there talking to his computer the whole time. I like to think that Danny just turned the camera off and kept talking.
Awesome.
Thanks. Have a good hour.
Thank you. All right, everyone. Welcome back to another hour of Fool24. I'm your host, Rachel, and I'm joined by Danny today, my awesome co-host with the amazing shirt, as always. How are you, Danny?
I am doing remarkably well. It's actually supposed to be sunny and 72 in San Diego today. So
nice.
I plan on getting out and taking the puppy for a walk later on.
Well, that sounds like fun. Well,
yeah.
Fools, we're going to be talking about advertising stocks today. And I see we have a lot of questions in the queue as well. And we'll try to get through any of those that we are able to answer in this hour. But also, if you happen to have any questions around our theme, broadly speaking, in the advertising space, we'd love to get to those too. And this is a really interesting theme, I think, both for you, Danny, as well as for myself, because there's some of these more traditional ways to approach investing in this space, right? You've got the big tech giants that I think people automatically think of when we talk about advertising, and then you've got some of the smaller companies on the programmatic advertising side, right? So there's a lot of different ways to play this space, and the growth of digital advertising has been explosive in recent years. We've also seen that there's been fluctuations in this space, both during and post pandemic. You had a situation where ad spend was reaching, record highs during the height of the pandemic, with so many people at home, eyeballs glued to their phones because we couldn't go out and, leave the house. And then in the period that has followed the pandemic, where, concerns about, consumer spending patterns, as well as just broader macro concerns, have impacted, advertising spend. And yet now we're starting to see a recovery there. But I'm curious, as you look at this space, what are your thoughts as you approach, the investability of it?
I think one of the things that I like to keep in mind is that advertising isn't going away. Even though there might be peaks and valleys in the advertising space. You were just talking about one of the peaks that we saw during the pandemic, and then one of the valleys that we saw during the economic downturn. It's well known in advertising circles that at the first sign of economic uncertainty, companies tend to slash their budgets, to meet that uncertainty. And the first place, or one of the first places on the income statement, on the profit and loss, where companies look to cut expenses is in their advertising budgets. That's just the way of the world. And so we saw that during the downturn as basically advertising stocks took it on the chin. But that is an industry that is resilient. Companies want to get their products and services in front of consumers. It drums up business. And so, even though there was a downturn, even though we saw, many advertising businesses get hit hard for a couple of years, they've all come roaring back to reach new heights. I did look up a couple of metrics to kind of give this context. According to Amperity, which is a ad tech platform, they said that overall advertising spending surpassed $1 trillion last year. Now, numbers vary a little bit. I read some other places where it was more in the neighborhood of 700 and plus billion, and it would hit $1 trillion within a couple of years. So there's a little bit of variability depending on who's giving you the numbers. Now, within that $1 trillion market, whether we hit that last year or we hit it in the next year or two, there is the digital advertising, and that is advertising that you see online, on your phone, on streaming video, anywhere that is outside of the paper or television markets. And that market, digital advertising, hit, looks like 734 billion last year, is expected to hit 843 billion this year, and has been growing at a compound annual growth rate of above 14% for a number of years now. So this is, that helps to show the resilience of the ad market and the opportunity that still remains for investors.
Yeah, absolutely. Yeah, thank you for providing those stats, Danny. We had a question about one of the stocks in the space that I look at a lot. Let It Ride was asking a few minutes ago thoughts on Pubmatic. So maybe I'll hit that one real quick, and then I'll give the floor back over to you, Danny. I know there's a couple stocks you wanted to talk about as well. Pubmatic is an interesting one, right? So So they're a digital ad tech company, right? So they help publishers and advertisers, maximize their revenue and ROI. Their platform uses real-time analytics, automation, machine learning to connect publishers with buyers. And they offer tools like header bidding, real-time analytics, audience insights. They take a real, publisher-centric approach, and they primarily serve publishers of websites, videos, and mobile apps. So how they make money is by charging a fee, which is typically a percentage of the ad revenue generated by those publishers when they use their sell-side platform or SSP to sell their digital ad inventory to advertisers. One of the things that's notable to how PubMatic's platform works is that advertisers bid on basically inventory ad space. So when an ad impression is available, advertisers connected to demand side platforms, which are called DSPs, they compete in real-time auctions to purchase ad space. Now, this is a really interesting and common thing within this space, but PubMatic has dealt with some issues because it has significant reliance on a few of these large demand side platform partners. So if there's changes in their bidding strategy, that can significantly impact revenue or the cut that they take from each of these ad inventory that is sold. They also make money, from additional fees for different services like advanced analytics or custom solutions, but most of the money comes from a percentage of ad revenue that's generated by publishers when they sell their ad space through PubMatic's platform. And, what I mentioned about how PubMatic has been dealing with kind of an over-reliance on just a few really large DSP partners. This is one of the reasons the company, is still not profitable right now. They obviously have been dealing with increased competition in the ad tech space. There has been, shifts, as we've talked about, in targeted advertising procedures and spending. Something else that has been an issue for this company is that something called third-party cookies, phasing that out, which is really important for targeted advertising. That's presented some challenges for PubMatic. So, I like the business. I think the thing that's always worried me a bit with this one is the fact that they are so reliant on a pretty small number of these demand side platform partners. So if those clients' bidding strategies shift, their business practices shift, when publishers sell ad space, their cut, which is the biggest driver of their revenue, it's smaller. Now, they will report their 2024 earnings in a couple days. I believe they report on the 27th. In Q3, their revenue was up about 13% year over year. They did have a pretty solid net dollar-based retention rate of 112% for the trailing 12-month period. They're not, profitable under GAAP, as I mentioned. They do have a positive operating cash flow. They delivered about $19 million in cash from operating activities in Q3. So this is one I have some mixed feelings about. It's not a company I currently own. I've mentioned a few of my concerns about the company's growth. Maybe if this was one I currently owned, I would probably hold on to a small position of it. I mean, something they did note in Q3 is that 70% of the top streamers are now on PubMatic. So they have a really critical mass of inventory to meet the surge in ad demand on their platform. Again, their net dollar-based retention rate is really solid. Revenue is growing at a nice clip in the double-digit range. And I think that they are working to expand and diversify, where their revenue comes from. So I still like the business. I think they need to execute on a few of these things before I would want to take a position. Those are just my thoughts.
So we've got a question from LY Winners Win. I love the concept of let your winners win. From a minute ago, what's the difference between the Trade Desk and Criteo? Tickers TTD and CRTO. So I need to take a step back for a minute and just kind of lay out how the advertising market, the digital advertising market, is segmented. So that is broken down between the supply side and the demand side. So on the supply side, you have the companies and that are platforms that are trying to sell the advertising spaces, which is, if you have a website and you want to put an ad on that website, then that space is available for sale. So that's the supply side. On the demand side, you have a platform that's trying to actually sell the advertisements or to place the advertisements. So it's two different sides of the same coin. And to that, you have Criteo, which is a supply side platform. And the Trade Desk is a demand side platform. So, we'll take that a step to, go back and now apply that. So, Criteo, which is your supply side platform, is selling the advertising spaces, whereas the Trade Desk is actually trying to match the advertisements to the people that are going to see the advertising. So that's kind of the short version. And I know that's confusing. You kind of need a scorecard to keep up with that. But on the one side of the platform, Rachel was talking about Pubmatic a little ago. Pubmatic and Criteo are actually both on the supply side, and they are supplying these ad spaces. And the Trade Desk is on the demand side, and they are trying to match the advertising that is available. So that kind of that should be. I hope that clears that up.
Awesome. Thanks, Danny. And I don't know if there's a company that also, as we look at the ad space, if there's one or two that you really are most intrigued by as we kind of talk about this. I know there's a few I had up my sleeve, but I wanted to hand the floor over to you as I started off talking for way too long.
Well, I think for someone that is looking for, the more stable, consistent performers in the space, the three biggest digital advertising companies in the world are Alphabet, which is ticker GOOGL, and they get their advertising thanks to Google search. You have the Meta Platforms, ticker META, and Meta Platforms has a lot of advertising space available on its social media platforms. And then you have Amazon, ticker AMZN, and they have a lot of advertising space, primarily the digital real estate on their e-commerce platform. But Amazon has been expanding. The Amazon Prime Video now comes with advertising by default. So if you want to watch something on Amazon Prime Video, you're going to see commercials unless you pay them the extra $3 a month to opt out of that. So, these are the three biggest players in the digital advertising space. And I went back to take a quick look just to kind of get an idea. So just in the advertising space, we'll start with Alphabet. Alphabet grew its advertising from 65 billion in the fourth quarter of 2023 to 72 billion in the fourth quarter of 2024. Meta Platforms gets virtually all of its advertising. And I say virtually because let's say like 97, 98% of its advertising or its revenue from advertising. The last quarter of last year, their revenue of 48 billion increased from 40 billion. That's up about 21%. And then, of course, Amazon, you think primarily about e-commerce and cloud computing, but Amazon is actually the third largest digital advertiser in the world. And they grew their advertising revenue, let's see here, in the fourth quarter, what was just short of 12 billion, up from about 10 billion in the fourth quarter of 2023, and that increased. I'm sorry, I just read the wrong line. Up to 17 billion, up from 14 billion, or up about 18%. And over the course of the year, advertising was actually the fastest growing segment for Amazon, even outpacing the growth of its AWS cloud computing. So, these are three of the biggest digital advertisers. I imagine that while the percentages of advertising among them will change minutely, these are three big ways that you can bet on the digital advertising market, and do it in kind of a less risky way. There are some others. Rachel and I will both talk about those here in a little bit. Rachel?
Yeah, after talking about Pubmatic, another one that comes to mind is Magnite, right? And so, like Pubmatic, they use demand side platforms, which I explained, to help advertisers and agencies access video inventory. That DSP model is incredibly common in this space, but they also, unlike Pubmatic, they have a direct route to video inventory that they offer called Clearline. So they're not so reliant on just a few of these DSP sources the same way that Pubmatic is. Like Pubmatic, Magnite makes money by acting as a sell-side advertising platform, right? So they're facilitating the sale of digital advertising space from publishers like streaming services, for example, which are major clients for companies in this space. So they help facilitate the sale of this digital ad space from clients like streaming services to advertisers, and they provide a tech platform that allows for automated programmatic ad buying across all these different channels with a primary focus on connected TV, right? And they earn revenue by taking a commission on each ad transaction that happens through their platform. So to kind of give you an idea of how it works for anyone who's not super familiar with this company, publishers, so let's say a streaming service, they'll integrate their ad inventory onto Magnite's platform, and that makes ad space available to advertisers who want to engage in programmatic buying to buy that space. When an ad impression is available on the publisher's site, Magnite then facilitates real-time auctions where multiple advertisers can bid on the ad space based on whatever their specific targeting criteria is. And they support ad sales across a wide range of platforms, including desktop, mobile, connected TV, which, as I mentioned, is a huge area of focus for them. Looking at in terms of their financial results, right? So they have not yet reported for the full year 2024. It is worth noting that Magnite is a company that helped support Netflix's initial programmatic connected TV ad launch. So they've been really integral in that journey. In Q3, they delivered total revenue of $162 million. That was up 8% year over year. They actually are also profitable under GAAP, although they've been working to establish consistent profitability. So whereas in Q3 2023, they had a net loss of about $17.5 million, they delivered net income of $5.2 million in the recent quarter, and they also reported operating cash flow of $40.2 million. I'm a little bit more, I should say considerably more bullish on this stock personally than I am on Pubmatic. I think that their revenue model is a bit more resilient. I think that they have a much more kind of diverse potential base for income and revenue. And I like the fact that they are working to build towards consistent profitability. Their operating cash flow position looks solid. And they mentioned in Q3, we're pleased to have launched our initial programmatic markets with Netflix and continue to ramp up with them through Q4. So that's something I would definitely say investors should watch for comments on that partnership in their upcoming 2024 report. So that's another interesting business on this side of the space. I know we have a lot of questions that are coming through. I don't know if there's one you want to grab, Danny.
There are a couple of questions here on the trade desk, and I think Duffer WD's question from about 15 minutes ago is, kind of hits the nail on the head. Thoughts on the trade desk, ticker TTD. It's tempting to buy, but Tom Gardner's concerns from a week or so ago is holding me back. So we can't offer personalized investing advice. And with all deference to Tom Gardner, I think whether or not an investor is interested in buying the trade desk really depends a lot on your personal situation. For instance, if I was an investor that was looking to, make a quick buck, or, looking to investing something for a short time, the trade desk might not be, the right stock for me. On the other hand, if I was an investor that had a long investing time horizon, and was willing to, take some funds, put it in the trade desk, and leave it sit for a time, this is an investment that might be better suited to me. Now, the questions that came up is with regard to the trade desk. It reported its results here on the February the 12th, so a little more than a week ago, not quite 2 weeks ago. And the company did not meet their own expectations, didn't meet Wall Street's expectations, and the company owned it. They said, we didn't meet our expectations, and it was our fault. And so first of all, for me, I like when a company makes a mistake and they own it. So that's the first part to me. The second thing is they said, we stumbled to a series of small execution missteps. They were kind of focusing on setting the company up for the future, and they didn't execute in real time. And to be honest, for any company, every company makes mistakes. I don't know any company that's perfect. I don't know any person that's perfect. And so, for a company with a track record like the trade desk, if you go back and look, the trade desk has been around. They went public, I want to say back in 2015. Or sorry, 2016, late 2016. And the stock has gone pretty much up and to the right ever since then. Now, there have been several occasions where the stock has gone down, 30 or 40 or 50% because it's a volatile stock, and because investors have really bid up its valuation. So is it possible that the trade desk could continue to fall? Yes, it absolutely is. Do I believe that the trade desk stock will be much higher 5 years from now or 10 years from now? I absolutely do. And I'm not selling any of my shares in the trade desk. So it really depends on your personal situation. But I believe the trade desk is a really compelling opportunity at this point.
So there was a question that came in several hours ago from Ted Has Options. I like that handle. Any take on Sprout Farmers Market's earnings? So kind of switching gears for a minute. Seem good, aligned to what management targeted. Market didn't like it, however. Thanks. So I think that this is an interesting one to cover, especially as we're looking at a time where I think a lot of people are paying very close attention to consumer spending behaviors, and any numbers that we see about that is a bellwether for future economic health. And the viewer is right; they actually did have a really pretty great financial report. So I wanted to go through that quickly. Sprouts, they obviously are known for their curated selection of health conscious, natural, organic products. Whenever I'm in the States, I enjoy shopping there. It's worth noting that they beat what analysts had been projecting in terms of earnings per share. And they actually delivered significantly above what analysts had been projecting. Looking at the actual numbers, so in Q4, their net sales totaled $2 billion. That was an 18% year-over-year increase. Comparable store sales grew 11.5% year-over-year. They opened 12 new stores just in the final 3 months of 2024 alone. Now, looking at the full year, net sales totaled $7.7 billion, a 13% increase from 2023. They delivered comparable store sales of about 7.6%. And they opened 33 new stores in the 12-month period, which resulted in having 440 stores open in 24 states as of the end of 2024. This is a company that's also profitable, which I think is worth noting. So in the 12-month period, they delivered net income of about $381 million. and that was compared to about 259 million a year ago. So really, solid figures. And what's interesting looking at a business like this, right? I mean, they do have a diverse range of products that they sell, but they're not necessarily as accessible from a price point perspective as, grocers at, available with companies like Walmart or Costco, for example. And some of these other, bigger box store types. Target grocery segment is another one. But they are continuing to do really well, to report really consistently, growing profits. It is worth noting the stock is still up well over 100% over the last year. It seems that in the last couple of days, the market hasn't been maybe particularly easy on the stock, but we've also been seeing a lot of volatility in the wider market that also, I think, seems to be impacting some stocks that haven't even reported anything particularly negative in terms of news. So I think that that's something just to be aware of. But yeah, this is, not a company I follow super closely, but I really do like kind of diving into these sometimes and seeing, what the state of these types of companies is. Like I've mentioned, I've shopped at Sprouts for a long time, haven't really approached it too much or studied the company much from an investment perspective, but just a quick look at these numbers. And it was definitely, by all accounts, a pretty solid year. And like I mentioned, over the last year, shares seem to have been responding in kind. Let me see.
We have several questions in here about the trade desk, and I think I've kind of beat that horse a little bit. I'll change gears here as well. A question from Ed from about 25 minutes ago. He asks, "What is your honest opinion of Tesla?" I am a Tesla shareholder, and I have some concerns. I think that the reason that Tesla has been so successful is because of the singular focus or relatively singular focus of CEO Elon Musk. Now, we know that, while he was focused primarily on Tesla, he was also working on the Boring Company and a company that's creating an interface for the human brain. And then he bought Twitter. My concern now is the fact that Musk may be spreading himself too thin. He is a lot of his focus these days is on the Department of Government Efficiency as a special employee for the Trump administration. And as a result of that, that's neither here nor there, other than it impacts on his time and focus. And while he is taking so much time and focus on other things, I feel as a shareholder, he's spending less of his mental energy on Tesla. Now, I don't know what that's going to mean for the company going forward. So I think as a Tesla shareholder, if I'm going to continue to hold that stock, I need to be cognizant of the fact that Elon Musk is doing other things right now, and that may impact Tesla's results going forward. I think we were already beginning to see softening in the electric vehicle market. We've seen other companies either exit the electric vehicle market primarily or altogether. We've seen some players in the electric vehicle market file for bankruptcy. So, this is a space that's in flux, and I kind of feel like it needs his attention. So, I have concerns. I'm not selling my Tesla shares yet, but a lot of my future decision will be on how Elon Musk decides to pay attention to the company, honestly. That's kind of my honest opinion of Tesla. I think we are at risk right now as shareholders. Me personally, as a shareholder, risk seeing the company lose its direction, as it were.
Yeah, I think that that's fair. There was a question that came in from Ed about 25 minutes ago. Amgen has been up almost 15% in February alone. What gives? Do you like it as a long-term hold? There hasn't been a ton of, big news from, the actual company. They did report a pretty stellar Q4 and full year report. They also they recently announced that they're going to be investing $200 million in a tech and innovation site in India, which is going to be, I think, a huge element of their continued expansion. And this is a business that has been doing really well anyway. For anyone that maybe doesn't follow Amgen, they are, I think, one of the top biotech companies. Arguably, they are definitely one of those more established type of biotechs that has a really nice lineup of approved and profitable products, as well as a really promising pipeline. So they're definitely not, the riskier type of biotech that we talk about sometimes on the show, where you're looking at, businesses that maybe have one product or everything is completely in the pipeline and they're pre-revenue. So for example, like one of their top selling drugs is a drug called Prolia. It's an osteoporosis treatment that's, helps inhibit bone breakdown. Enbrel is another one. It's an anti-inflammatory drug used to treat rheumatoid arthritis and other autoimmune diseases. Another one of their top selling drugs is Otezla, which is for moderate to severe plaque psoriasis. And then Blinkcyto is another one of their top drugs, and that's a chemo drug specifically for acute lymphoblastic leukemia. So they reported in 2024 that 10 of their products delivered at least double-digit sales growth in the fourth quarter and in the full year. And a few of the drugs I mentioned were some of the key drivers of that growth. Looking overall, total revenues increased 19% year over year to about $33 billion. That is a very solid growth rate for a mature biotech business. So that's something that I think has probably driven a lot of enthusiasm around the stock. I mean, just to kind of give a little bit of context there, when you're looking at some of these bigger biopharmaceutical companies, for example, sometimes low to mid single digit growth rates are common. So that's a very solid growth rate for them. They did make an acquisition of a company called Horizon last year, which is going to weigh a bit on the bottom line. So if anyone follows the stock, their GAAP EPS decreased about 18% in Q4, but they were still profitable. And again, that was largely because of the acquisition that they made. And they also reported that 21 of their products achieved record sales for the full year. So this is one of those examples where I think you're seeing investors have continued to respond well to a company that is executing well. We have talked about a lot of stocks on the show during earnings season that have maybe not always performed in the way one would think, given the types of financials they reported. I do think there is also something to be said for, in a volatile time, and we're seeing a lot of, I think, fear and uncertainty in the markets right now. I don't think it's surprising that some investors might be more drawn to some of these healthcare-centric businesses, right? And especially some of these more established biotech, pharmaceutical, medical device stocks, just broadly speaking, all these different segments of healthcare, because there does tend to be a lot more economic resilience in these types of businesses. They're not immune to shifts in the macro environment, but they do tend to have a lot more resilience and a lot less cyclicality. So I, in my opinion, I also think that might go back to some of the stock price movements you're seeing. But, the company's doing well from a financial perspective. They're seeing, really steady double-digit sales growth across some of their top products in their different disease areas that they focus on. They break it down by segments, including general medicine, rare diseases, inflammatory drugs, oncology drugs. It's been a really, really solid period of growth for them overall. And some of their older products that are closer to loss of patent exclusivity that are, growing much more slowly than they were a few years ago. You're seeing really solid growth upticks in some of their newer drugs with greater longevity that is helping to offset that. So I think that there are good things happening. I'm pretty bullish on this business. It's one of those companies I like as a way to invest in biotech, but invest in a really established business that has, a proved they have a solid foundation of growth. And I think, carries a little bit less risk than some of these early stage companies we talk about that are obviously pre-revenue.
So we've got a really interesting question that, kind of intersects with our theme really nicely. This is from our own Pro Shop guy, Mike, 25 minutes ago, asked, thoughts on Walmart on building a closed loop with Vizio and an in-store app with ads, giving companies a better read on conversion rates of ads. This is really intriguing to me and something that I have followed tangentially. I am not a Walmart stockholder, I'll say that. However, I have been watching with fascination from the sidelines. For investors who may not be familiar with this, last year, Walmart announced that it was acquiring Vizio. Now, Vizio is one of the companies that created it has its own operating system on its televisions. Walmart was one of the biggest sellers of those smart television sets. And what Walmart has done is they actually have in-store advertising, which is the company has been playing ads on displays in its stores, and it can then discover in real time whether or not that advertising is effective, because they know if a customer sees an advertisement and then within an hour or two of those ads playing, the cash register rings up sales of what it's advertising. They've got almost immediate feedback on the effectiveness of their advertising. So now what they're doing is they're also now that they've bought Vizio, the company has been expanding its advertising business in a couple of different directions. And it's actually working. Now, Walmart, because this is such a small part of its business overall, Walmart only reports its advertising revenue about once a year. It only breaks it out annually. So when it reported its fourth quarter results, I think it was probably a week or so ago, they said they generated $4.4 billion in global ad revenue, which was up about 27% year over year. So the company has a couple of different places where it's getting data from. So, it's got its e-commerce site, walmart.com. So it's getting, kind of data-driven advertising results there. It's got its in-store advertising, and now it has this Vizio, smart TV system. When asked about this, Walmart CEO Doug McMillon said, our evolving business model with a more diversified and durable sources of profit like advertising, he also members membership, has enabled us to grow operating income faster than sales despite headwinds. Now, if you look at Walmart's overall sales growth last year, that was only an increase of only about 4%. And its operating income was up by 8%. So you can see that the company is really interested in getting into this, getting further into the advertising business because it's so much more lucrative for them. So the reason I found this so intriguing is because this was a brilliant move on the part of Walmart to, kind of expand into this advertising. They took a page from the Amazon playbook. Amazon has long put advertising on its e-commerce site. Walmart's now doing the same thing. It has the physical retail locations, so it can, play ads on these displays and get immediate feedback on the on whether or not that advertising is effective or not. So I think the combination of areas that Walmart is getting into is, I think it's really not only fascinating that they decided to do that, but I think it's a testament to Walmart's execution. I mean, this works really well when melded with their e-commerce business and their physical retail business. So I think it was brilliant. And I don't know who the guy was that thought of it, but kudos to them because it's working remarkably well.
So we had a question come in from LY Winners Win, Let Your Winners Win 41 minutes ago. Rachel, what catalyst would make Sweetgreen the next Chipotle or Taco Bell or Starbucks? That's a really interesting one because I mean there's some areas of intersection here, right? I mean, Sweetgreens is a much younger business, right? They were just founded in 2007, I think, and they have locations across the U.S. They've indicated that they intend to expand internationally. They've said we want to be the best in the world at serving healthy salads and bowls. I would say probably the most direct competitor I can think of would be Cava. There's definitely some overlap there. But they're this fast casual restaurant chain. They serve salads and bowls made with local, organic, and sustainable ingredients. So definitely some differences in terms of the food that's available at most Starbucks locations or Chipotle or Taco Bell. In terms of their ability to expand, I think they obviously are targeting a different type of customer shopping habit than any of those, three examples, right? I think they're really, targeting people that are looking for some of these healthier options, maybe are willing to just pay a little bit more than they might at a Taco Bell or Starbucks, and are willing to, pay a little extra for those seasonal, fresh ingredients where they can, build the bowls that they like. I think their ability to expand and not expand too quickly will be really key for them to be able to retain the growth trajectory they're on. I've talked about before with this company, one of the things that I have found really interesting about them compared to some of these other, quick service category type restaurants is their use of robots in the kitchen, these infinite kitchens that they've been retrofitting in existing locations and building new ones. That it's designed to improve the overall customer experience and hopefully reduce labor costs and over time, increase same store sales, where essentially you've got these kitchens that dispense the salad orders into bowls on a conveyor belt, and employees monitor the screens to make sure, the dispensers aren't running low on ingredients. And I believe employees also are responsible for the final check of the salads, right, before they're handed over to the customer. But a lot of the actual compilation of the ingredients is done by these robotic kitchens. And Sweetgreen reports their earnings tomorrow, I believe, and they had previously said that they were hoping to open 7 new restaurants that featured infinite kitchens in 2024. So that's something I'll be watching for. They're not profitable currently. And obviously opening and expanding these infinite kitchens is a very capital intensive endeavor. They started on this journey because of an acquisition of this robotic kitchen company that they made a few years ago, and they have built on that acquisition since then. So I think that their ability to differentiate themselves specifically in the quick service health food market is going to be key. I don't necessarily think that they directly compete with, say, a company like Starbucks. I don't think that necessarily someone who goes and picks up a few items at Starbucks would be any more or less inclined to then go and, eat something at Sweetgreens later. So I think for them, their ability to grow intentionally while not overshooting their growth, their ability to actually succeed with these infinite kitchens that they are really pretty rapidly deploying, and their ability to get to more consistent profitability will kind of be key over the long term. But they really have worked to carve this kind of specialized, niche for themselves of very healthy, accessible food that is kind of designed for the health conscious consumer. And I do think that's a little bit different than some of these other companies we talk about in this category. So, you could foresee a situation where a consumer shops or goes and orders from these restaurants at different points in the week, and sales from one place doesn't necessarily detract from sales at another. But I do think there's some different types of customers in terms of what their food desires and goals might be that could eat at these places. So I don't necessarily think, the continued success, for example, of these big brands that we all know would necessarily deter away from Sweetgreens. Obviously one thing you would watch is, depending on how the trajectory of consumer spending evolves in the coming months and the next couple years, Sweetgreen definitely has a little bit of a higher average order value than maybe if you go and order at Taco Bell, for example. So how does a company like that fare if consumers are pulling back on spending a bit? These are things that I think anyone investing in this space needs to think about. But I think their ability to keep doing what they've been doing while working towards profitability will be really key for them to remain strong contenders in this space over the long run.
So I saw a question about Costco. Now, I'm not a Costco shareholder, but I'm familiar enough with the dynamic that's going on in retail right now. And the question is, this is from Happy Fool 2 hours ago. Is this why one sees cost going up? I'm assuming this means the Costco stock. People seem to think that Costco is cheap. If one actually looks closely at their prices, it's not so for many items. I think the reason why we're seeing Costco stock go up is because the company is reporting results that investors like. And just to give you a little comparison, so when Walmart reported its most recent quarterly results, they said their revenue grew by 4.1%. If you look at what Costco said for its first quarter of 2025, their revenue grew by 7.5%. So, while 4.1 is good, 7.5 is better. And if you look, Costco reports monthly at what their sales are doing. And earlier this month, they reported that their net sales increased by 9.2% compared year over year. So I think the reason why Costco stock is going up is because the company's financial results are telling. Now, one thing I want to point out for investors who may not be familiar with Costco, the company actually makes the bulk of its money from membership dues. So, customers go in there and they pay for the privilege of shopping at Costco. So basically that draws a line under, the company's revenue and profits. And how well they do on selling products in their stores is kind of secondary to that. So as long as members feel like that they're getting bang for their buck, whether they are or not, they're going to continue to renew those memberships, which is the foundation upon which Costco is built. Rachel?
Yeah. Costco has been one that I have really admired for a long time. And, you're right. Most of their profitability comes from those membership dues. And so they're able to really retain these very slim margins on their actual product sales because they have the reliability of that membership income. And they have, I think, well over 90% renewal rates in their core and their total markets. And then in North America, where most of their locations are based, that is also the case. So it's been a really resilient business. Speaking of big retailers, right? So Ed was asking Target reports next week. Last 4 quarterly reports, miss, beat, miss, rolling the dice with a beat, consumer spending, might it hurt the stock? Yeah, Target is one that I like as an income investor. And I actually want to pull up the exact number right now as I'm looking at this, so I don't say the wrong one. So the stock continues to not be a good performer, right? It's down double digits over the last year. That has helped to push the dividend yield higher, which is something you often see with a company that's share prices are flailing a bit. That yield is around 3.5%. The company's also currently trading at a price to earnings ratio of 13.47. I mean, this is it's not the lowest the company has traded in the last couple of years, but the company's getting pretty close to its 52-week low. Just to give investors an idea, they've kind of had some unique struggles. Like we've seen, obviously, big retailers like Walmart that have come out with more moderated sales projections for the new year, but still growing at a really solid clip. Costco's still doing well. Those are a couple examples. Target has, faced backlash from some consumers over a number of initiatives, gone wrong. They have had, rising costs that they've had to deal with, like a lot of other retailers. But they have a lot of discretionary items that they sell. They do obviously have things like their grocery segments and some of the Target locations, right? But we've seen a trend where customers are prioritizing more basic necessities over discretionary items. And compared to Walmart, consumers tend to often see Target is maybe coming in at slightly higher prices, which is, sometimes the case. So there's definitely been, I think, issues there in terms of consumer perception and sentiment on a range of issues. They've obviously dealt with excess inventory that they had to offload. They had dealt with an increase in retail theft, which management said had further impacted their profitability. But I think a lot of it comes down to shifting consumer behavior, of that prioritizing essentials over discretionary spending. And while they do sell a lot of essentials in their stores, they have a lot of exposure to just discretionary types of spending categories. And I think that's one of the biggest things you're seeing. They reduced prices, for example, on I think something like 2,000 of their products for the holiday. Walmart is obviously their biggest, probably low price rival. That's the most one-to-one type of comparison. Walmart, meanwhile, at the end of the year had reported a really solid quarter of sales. So, it's hard to say exactly what's going to happen with the company next. I am of the belief that if consumer spending conditions improve, this is a company that can benefit, right? I mean, just to add a few numbers behind what I'm saying. So their comparable sales in Q3 increased just 0.3% year over year. So super slim growth. But they reported that their digital comparable sales grew 10.8% year over year. And they also had 20% increase in same day delivery in Q3. Guest traffic grew 2.4% year over year. And although earnings were down, they are, still reporting profits, right? So their net earnings were $854 million in Q3. So down year over year, but still profitable. So I think this is going to be a tough one for shareholders, probably in the coming quarters and even potentially over the next year or so. I think a lot of the factors impacting the business are not entirely within Target's control, right? They've worked to slash inventory levels. They've decreased prices on some of their products. I think they're, struggling in a time where a lot of consumers are flocking to much lower priced tier stores that offer a much broader range of essential products than Target does. In a situation where consumer spending accelerates, I think Target could be, well poised to benefit from that. But I do think, some of it has been some things where Target has got it wrong kind of coming out of the pandemic. And I do think some of it has been, just broadly speaking, the state of the spending environment. And unfortunately, Target is not benefiting from the same tailwinds that companies like Costco and Walmart are.
So we've got a question from Ed about 16 minutes ago that I think asks a kind of a pertinent question. Do you think the next downturn, and maybe it started, starts with tech and then morphs into other sectors? I think that we learned a lot about the market and downturns in late 2021. And what we learned, and I agree, it does look like that it kind of started with technology. We had a lot of technology stocks that fell. It seemed in unison in November of 2021 before it spread to the whole market. But I think there's a little bit more detail there that is often overlooked, and that's the fact that it wasn't just technology. I think it kind of started with technology stocks that were overvalued. And that's actually been pretty consistent going back over the years. If you have stocks that are overvalued, that are highly valued, that have high price to earnings ratios, high price to sales ratios, and their fundamentals don't support their valuations, then when you start to see cracks in the economy, investors get nervous. And one of the first things some investors do when they get nervous is they sell off their stocks that have high valuations. And as those cracks in the economy tend to expand, it's not, you see that in any high value stocks, but since technology stocks tend to be more highly valued than, say, industrial stocks or consumer goods stocks or energy stocks, then it might seem like there's a, kind of a wholesale sell-off going on in the tech sector. What I do want to clarify is I don't necessarily think that we are seeing the beginnings of a downturn. Now, I don't have any insider information. I've just been doing this for a little while. And I said this a couple of hours ago. The bull market has been running for more than 2 years now. And we passed the 2-year mark probably 2-3 months ago. And so we haven't had a significant correction. Our correction is defined as a decline of the major market indexes by 10% from the recent high. And we haven't seen a major correction happen in recent years. And I think that is a normal and healthy part of the market overall. So if you're starting to see, some of the cracks here, I suspect, again, I'm not an expert, I'm not an economist, but we could be seeing, the beginnings of a market correction. We could also be, seeing just a retrenchment before the market goes higher. I don't know anything more than anybody else does. I will say that even if that is the case, I'm not selling anything on my portfolio based on the overall, look of the tech sector.
Yeah, no, I think that's really true. It's so hard to know these things, right? There's no way to really accurately predict. None of us can look at the market and time it accurately. Even if one of us was to, be lucky one on a one-off experience, right? It's just not possible as retail investors to be able to consistently experience durable and sustainable returns that way, and are kind of focusing on a long-term investing strategy where you're really focusing on investing in quality businesses that you hold for years is really the advantage that we have as individual retail investors. And there can be opportunities for retail investors in downturns as well as periods when the market is doing, exceptionally well. It's very much the case that a lot of these tech companies we talk about are more prone to volatility and even cyclicality, right, than some of the more resilient, slower growth sectors. And that is often reflected in these kind of wider share price swings. But I think it's understandable that I think some investors are unnerved right now looking at the state of the market. But something I think about even as a newer investor in the last several years is continuing to focus on the businesses that I feel are quality additions to my portfolio, for a minimum of 5 years or more, and holding on to those, even if a downturn comes. For me, I'll have some capital in reserve that I hope to put to work. But if your thesis on a business remains the same, even a period of downturn that lasts for months or even a year is still a pretty brief period in the longer lifespan of your investment as a long-term investor. That's something I tell myself anyway a lot, which has been comforting during a pretty volatile start to my investing journey over the last 5 years.
And with that, Rachel, we are at the top of the hour, and I think that we're about to be joined by Toby. And
This is true.
You're sticking around, right, Rachel?
I am. I'm here for another hour.
Well, fools, I will leave you to the very capable hands of Rachel and Toby, and I will see you again soon. Fool on, everyone.
Take care,
Thanks, Danny.
Hey, Rachel, how are you today?
I'm good, Toby. How's it going?
Good. Good for me. Noon here on the West Coast, 3 over there on the East Coast. We still have another hour in the market, my friends. So we're gonna sit tight here, wait till some earnings come in after market for the later show. But right now we're talking about valuation, as we always do at this hour. So if you have any specific valuation questions, you can get those in for us, and any other questions as well. I see that our question count ratio is higher now than it was when I signed off yesterday. So it's good. They keep coming in. I'd love to see them coming in. There are plenty of questions I think we can address as we're waiting for some of these valuation stuff or other questions to come in. Did you address this biotech issue? This question at the top here from India Farm?
Any thoughts on why NTLA and other biotechs are down today?
Kind of a general question. I don't know why.
I'm gonna have to look into this a bit more. I mean, Intelia specifically has been a pretty volatile biotech compared to some of these other businesses. I was actually just talking about a much bigger and more established company earlier, which is Amgen, right? And that stock is up just over the last month, around 12%, just to give some context there. I mean, I think we're continuing to see some volatility in the market. We're also continuing to see companies like Viking Therapeutics that I think are being sold off as there is uncertainty, about the GLP-1 space right now. I mean, we know that the news came out the other day from the FDA that semaglutide, which is the active ingredient in Ozempic and Wegovy, which is made by Novo Nordisk, and then you've got their top competitor, which is Eli Lilly, with Zepbound and Mounjaro. But the FDA basically said there's no longer a shortage of semaglutide, so all the compounding pharmacies, which are only allowed to make these compounded versions of GLP-1 drugs when there's a shortage of them, right, have to basically cease those particular operations. And while that specifically impacted compounding pharmacies, like companies like Hims and Hers Health that had that aspect to their business, I think that there's also been some concern among companies with exposure to the space of what does this look like over the long term? Is it oversaturated? I don't think that's the case. We see that there are so many potential use cases for GLP-1 drugs and studies that are ongoing outside of the most common, applications that we think of now, right, which is for diabetes care and weight loss management. So I think that there's also continued to be, especially in the biotech space, some volatility that you see, particularly among some of these smaller biotechs, right, that are not profitable, that maybe don't even have a product that is yet approved. And as I think there are concerns about the trajectory of funding, which is something that biotech companies rely on significantly, and spending in this space for some of these biotech's research partners has decelerated a bit, as there's continued to be some uncertainties about the economic environment. Those are some factors at play. I think you're also seeing more volatile stocks impacted by some of the market movements that we're seeing, especially in the last several days. And I've seen particular volatility among some of these smaller biotechs, and then moderate movements against, say, like a bigger company, like a big pharma company like AbbVie, which is still in the green in terms of being up year to date. So those are kind of my brief thoughts on some of what's going on there.
Yeah, I'm not seeing any specific news other than just like kind of a regular downturn. I do see some biotech ETFs are down, right? So it seems like it's a broad industry thing going on right now. So I wouldn't read too much into it, other than the stuff that Rachel has commented on already.
Yeah, and the other thing I would say is, in still elevated interest rate environment, it has made it harder for some biotech companies to access funding. That elevated interest rate environment has also kind of led to a slowdown in some venture capital investments, which has also been something that has been, apparent in the biotech space. And there's just concerns, as always, about regulatory uncertainty, drug pricing. You have some of these smaller companies that, one negative clinical trial can completely, impact share prices negatively. So when looking at this space, you can definitely see some trends. I think investors are worried right now are looking for places of certainty. We've seen some of these very slow growth types of value stocks in like the grocery space and other areas that have actually had pretty resilient share price performance even in just the last few days. It sort of seems to indicate that investors are looking for things that they deem as being a bit more certain in a difficult economic environment. And some of these early stage biotech stocks, especially, which are already carrying a significant degree of risk, are probably not as much in favor. But I think, as always, taking it on a company by company basis is important, and trying to understand what the movements are behind that company and whether it makes sense for my portfolio is something I try to think about, especially in these times.
Right. Let's go ahead and continue this thought on pharmaceuticals here, and hit Ed's question, who asked, Hims is down another 20% plus today. One of the Motley Fool analysts said he would not buy it with a 10-foot pole. Do you agree? Bold words. I don't know who said that, honestly.
I don't know.
So I'm not sure.
Well,
but
we're a motley group, right? We all have different
right,
takes on these companies.
Now, this is not a company I own. I will say I have used options on it a little bit for income in the past. I know that Travis Hoym likes this company quite a bit. He's talked about it from a positive standpoint. So part of what's going on with Hims right now, right, is what you were talking about with the compounding, like with the FDA saying, what a recent driver for Hims and Hers has been the weight loss drugs, right? And with the FDA coming out and saying, well, we're not going to compound anymore because there's no more shortage, that's an issue for them, right? So they're seeing a decline from that. Valuation wise, you look at them, we've got PE ratio is 41, but I think that's irrelevant for this company because they only became GAAP profitable, I think, this past year in 2024. So you can't put that in context, a reasonable context of their history, because it just doesn't make any sense, right? Price to sales 3.5. That's higher than it's been in the last couple of years, lower than it's been before that. So I don't look at that as unreasonable in their past. But it did have a premium valuation before the drop we've seen. That's for sure. And I think this leads into kind of we're talking about valuation here, Rachel, right? When you have a company that is priced for high growth, that does have a premium valuation, it doesn't take much to see a sell-off in the near term, right? Something as simple as saying, oh, this bit of business you had with the weight loss stuff that's going away now, that's going to take the stock down, right? It doesn't take too much to send a high valued stock tumbling, at least in the short term. So I think that's part of what is going on here. And I think that's just something you have to be aware of. It is perfectly fine, I think, to own companies that look like they have premium valuations, might even be overvalued. That could be the mark of a rule breaker, right? In David Gardner's style of investing. And if you believe that the growth trajectory is high, there's nothing wrong with holding a company that traditional valuation metrics might say is overvalued. But when you do that, you do have to understand that the slightest bit of bad news or the slightest bit of even neutral news, sometimes depending on the market environment, is going to send the stock down. It's going to be of a hit. You're going to have the up and downs, and you just got to be able to write that out. I think that's kind of what's going on now with Hims right now. Not to say that I think it's a classic rule breaker that's going to go to the moon, right? I'm just pointing out that the premium valuation, I think, is part of what's leading to the decline we're seeing here. Do you have any thoughts on this company?
Yeah, this is one I follow pretty closely. And it is interesting because they did actually have a really stellar Q4 and full year report. They beat on pretty much every key metric that one would hope for. And they did, I haven't had a chance to go through the full transcript, right, of their earnings call. But management certainly talked about what has been happening with the, news from the FDA, and specifically as it relates to compounded drugs, right? So the thing that was, I think, the most notable miss, but still just behind what analysts have been expecting, was that the company's gross margin in Q4 was 77%. Analysts have been hoping for 78.4%. So they were off by 1.4% from what analysts were hoping for. And what the CFO said was that basically the scaling of their GLP-1 offering and strategic pricing options around that, they blamed that category for the slight coming in under what analysts have been hoping for their gross margin. And as I mentioned, earlier, compounded drugs can be produced when brand name treatments are in shortage, such as what Hims and Hers Health and other companies were doing when Novo Nordisk's GLP-1 drugs were in shortage. Now that shortage has been resolved, they can't do that. The FDA is giving these companies, including Hims and Hers Health, time to wind down those operations. It is worth noting Hims and Hers has other drugs that are in shortage that they can address through their compounding pharmacies that they own and operate. So there's still opportunity there. And companies like Novo Nordisk, while currently their drugs are not in shortage, they have said that potentially in the future there could be some supply constraint issues. So you could see this being a potentially fluid situation. Management did say in the earnings call yesterday that they will likely stop offering compounded semaglutide on their platform after the first quarter, although some consumers might still be able to access, personalized doses. So you might still see some growth from that in Q1 when that result comes out later in the year. Now, just to give you an idea, though, of why I think some of the reaction is a bit of an overreaction. So the company's total revenue in 2024 was $1.5 billion, right? That was a 69% year-over-year increase. Only about 225 million of that 1.5 billion was from their GLP-1 offering. So not a figure to ignore, but maybe not the extent of the business that some investors might believe. So something I think to be aware of. They did also say that their weight loss offerings moving forward will primarily consist of oral medications, as well as an injectable medication called liraglutide, which they plan to launch on the platform later this year. Analysts did not seem to be particularly enthused by management's comments. There was an analyst at Morgan Stanley, for example, that said the report was, quote, a lot to digest. They did maintain their equal weight rating on the stock. Analysts have also commented that competitors will, probably shift marketing dollars back to other products for conditions like what Hims and Hers Health, focused on initially, things like ED and hair loss and some of these other types of concerns. And so, analysts seem to, at Bank of America, for example, were not particularly optimistic about where they think the trajectory of 2025 revenue will go. Obviously, we will see. The GLP-1 space is rapidly evolving. I, for one, did not expect compounded GLP-1s to be a huge part of the business, or to be a huge part of the business if they became one for long, because the fact is that this is only something that's allowed when a drug is in shortage. So I think investors should be aware of that. They did report 126 million in net income in 2024, free cash flow of about 198 million. Subscribers were up, 45% year over year. Could growth decelerate in the coming quarters as they work to realign? I think that's possible. But I don't think, looking at this, that this spells like the death knell for the business. So those are kind of my thoughts of where I'm at, and also just a little bit more than what I added yesterday after having had a chance to read some of management's comments. I think there's still a lot of opportunity for this company. I think that the GLP-1 space was probably going to be a very limited market for them. And I never saw that as like a long-term part of their business, but in the short term, I saw it as a nice tailwind. So we'll see how that impacts their 2025 revenue as they, decrease that part of their business.
Nice. Thanks. Let's hit Shimon's question from 2 hours ago, which I find intriguing. Is quantum worth investing in? Boom. I think yes. Quantum is certainly worth investing in because that's cool, and I think there's a lot of potential there. And of course, I got to be careful there. There's a lot of potential, but a lot of difficulties, a lot of challenges might not work out, right? But I bring this up, right, and I want to throw this out there because we do have that recent announcement from Microsoft with their new quantum computing chip, Majorna 1, that they just announced not too long ago, last week, I think. And they're saying, like, so this is powered. This chip is powered by a new type of architecture that uses the new class of materials they call topo conductors, which they say is a new state of matter, Rachel. So while everyone here has been spending their time worrying about earnings and arguing about which chatbot may be more biased than the other, Microsoft is over here creating a new state of matter, like entirely, which is fascinating and kind of over the top, but quite wonderful. Now, I do not know enough about theoretical physics to weigh in on the debate as to whether or not this truly is a new state of matter. I'm just gonna let Microsoft claim that it is and go with that. But it's super cool. And this, they say, it took them 2 decades to get to this point, to make this chip. And they say it will help them construct quantum systems, quantum computing systems that can scale up to 1 million qubits on a single chip here. Super cool. But this is still like it doesn't necessarily solve the ultimate problem, right? This is simply one more step towards creating stable quantum computing systems. But it's some good news, some good news in the field in there, which leads to the question: is it worth investing in? I think yes. But then
there's a lot of ways to, right?
Well, so that's the natural next question: how do I invest in this if I wanted to, right? Microsoft, Alphabet, IBM, right? These are companies, established tech companies that are working in this field. Now, if you were to buy Microsoft today, how much is quantum computing going to add to the bottom line? 0 right now. Like, there's nothing there. Yeah. This is still very early. And even if it becomes quite big and they say, oh, we can do it now, we've got a stable system, we can start putting applications together with this, I would say that that's still going to add very little to their bottom line because there's so much else going on. It's such a large company. But you like to see these big companies continue to innovate because who knows how big that will be. Could it be as big as AI? Maybe. Maybe not. But so there's one option, right? Your big tech companies, Microsoft, Alphabet, IBM, that type of stuff. That's one way to get it, right? That's a safer way to get it because if it doesn't work out for them, you still got the rest of the $1 trillion business, plus to play around with, right? Then we could go to these cool startups, right, that are working in the quantum space. There's some of them out there. I can give you some tickers. I want to be careful here. Please do not go investing in these just off the bat, right? But IonQ.
Oh yeah,
IonQ? Yeah.
I was gonna mention that one. Yeah.
Yeah, 7 billion, a little less than 7 billion market cap, so it's not nothing, right? It's not a fly-by-night startup. But I will note to you, my friends, that in the past year the stock has run up 178%. So as we get excitement over the field, and a lot of that has come, I think, like at the beginning of this year, basically, late last year or this year. So as we get more, anytime you see a breakthrough like what Microsoft announced and people get more excited in the field, boom, like the people working in that, the other companies are going to shoot up for that, right? So be careful with that. But this is an interesting little company. They're trying to develop quantum computing systems, general purpose quantum computing systems. I'd say at the forefront right now. I don't know. They're not profitable, right? So they're barely I don't even know where they get their revenue from, but they did have like 37 million in revenue in the last 12 months versus 223 million of operating expenses. So it's almost pre-revenue, right? It's just they're spending so much in development of this stuff that you can barely call them revenue. And then in terms of, I haven't looked at the cash flow statement. I will look at that now. I suspect to be not pleased.
I think it's, yeah, I think you won't be pleased, Toby.
Yeah, 140 million negative over the last 12 months. They're burning cash, which you would expect from a company at this stage. And I don't know, guys. 140 million in cash from operations on a burn, not making, for a $7 billion company, you can obviously see the optimism that people expect a lot in the near future or the far future, but they certainly expect something that gets you to better than burning cash. So be careful with this. $7 billion company that's burning cash, I don't know. But it's one to watch, right? Are there others that you're aware of in the field, Rachel?
This is probably the one I have followed a bit more closely, because they sell their quantum computers directly to customers, and then they offer quantum computing capabilities like directly through partnerships with companies like Amazon, like Microsoft, like Alphabet's Google. So IonQ offers their quantum computing capabilities through AWS's Amazon bracket, right? For Microsoft, it's through Azure. They offer access to quantum computers through Google's cloud marketplace. So, you can also kind of gain exposure to this sort of indirectly as well as directly through what these bigger companies are doing, if, by looking at companies like Amazon and Alphabet. But yeah, it's an interesting business. I think, and there's not one particular company I think of here, but more looking at as a broader long-term trend. I think about how we have like early data that's talking about how quantum computing could be used in drug discovery, right? Just like we talk about how AI has been really useful as an application there. Quantum computing, for example, quantum computers could simulate the process of protein folding, which is crucial to help understand how drugs interact with a biological target. They could accelerate the identification of these drug candidates by, simulating these molecular interactions that would be much more accurate than what classical computers would do. And they could probably, and they can, screen a much larger library of potential drug molecules that would help them identify candidates faster. So it goes back to making these things more efficient. So I think the use cases are definitely there. I think when you're looking at businesses at this space, it's still, especially direct plays like a company like IonQ, as opposed to, a much more diversified, bigger like tech company like these other names we've talked about. The actual company that is making and selling these technologies is a much, riskier venture. It's probably not for every investor. It's like, probably for more risk tolerant investors are going to be interested in a company like this because the use cases are there, but the adoption is still early.
Yeah. D-Wave Computing is another one. QBTS, $2 billion market cap right now. Burning cash, 60 million over the last 12 months. And then we've got Rigetti Computing, 2.5 billion market cap recently. Best guess, Rachel, cash flow positive or cash flow negative?
I have a feeling it's negative.
Boom, it is. They burned over 50 million in cash from operations over the past 12 months. So you see the theme, right, with these pure plays. Let me show you this, guys. We'll put, I'm going to share my screen really quickly here. We'll throw up this chart that I just pulled up. And this is the three companies that I just mentioned: Rigetti, IonQ, D-Wave. And you see, we got super excited about quantum computing, didn't we? Right at the beginning of the year. And then we got a lot less excited. Maybe this is when they reported Q4 earnings. That's probably right. And then we've seen a decent uptick, but there's been, so I've thrown this up here. Look, you can even go the last 6 months, right? And you see even the bigger thing here, with the last 3 years, you're getting the same sense from this, which is there has been a massive run up in these pure plays just very, very recently. And so I caution all of us to tread carefully if we want to invest in these pure plays. Very little revenue, no cash flow, very experimental field. Who knows if this is going to work out? Invest in these with money you're okay losing. That's the suggestion I would offer up if you're going with the pure plays as an investment. And again, nothing wrong with that, right? If you want to throw a couple $100 at these, and that's just not that much money to you in your portfolio, knock yourself out. That can be fun. I do this often with just random when I see something that's potentially cool, this is the cool company, let's put a little bit in, right? I did that with Virgin Galactic, right? When I thought spaceflight's cool, let me see what happens here. What happened was it basically went to zero, which is sort of what I kind of expected, but you never know, right? And sometimes it's not, you got to have a little fun, right, with your investing. And if you're someone who loves technology like I do, occasionally you do things like this, but just be careful with that, right? If I were investing in the space, I think, to Shimon's point, I'd probably go with just let the big tech companies do the heavy lifting right now and just see how things develop.
Yeah, I think that's true. This is interesting.
All right.
Ed was asking. This is
the fun question, Rachel, from 307 Fool. Do you want to address this one?
Oh, wait, which one?
If you were given $10,000 today, $10,000, and were forced to buy a holding that is new to you within the next day, where would you put the money? So I'm going to take this to mean not a company you are totally unaware of, because then how would he answer it? But a company that you do not own, right? That would, and you have not owned, that would be new to your portfolio. Where would you put that money right today? And I think this is just a more fun way of asking what's at the top of your watch list, right?
Yeah, I mean, I think I'd want to distribute
I think
it.
you're muted. I can't hear you.
It's not muted. Can you hear me now?
We may have lost. Oh, maybe did we lose Rachel or did we lose me? In terms of
I can hear you. Natasha's saying she can hear us both.
You know what happened here? It was not Rachel. It is for some reason.
I'm like, I don't think I'm muted. Can you hear me now, Toby? Yeah, I can hear you.
Let's see what's going on here.
Well, let me hit this question while you're working on that piece of it. So for me, I think that, I would probably want to distribute that into a few stocks. I think that I would want to diversify my capital. One stock, though, that I talk about a lot and that I've never actually owned is Airbnb. That's a pretty fascinating business that I have continued to be really bullish on over the last few years. And honestly, the only reason I probably haven't invested in it yet is I tend to wait for companies that are, more newly public. I tend to wait a couple years to see how that kind of thesis plays out before I go and take a position. So they obviously opened in 2020. And then there was a period of time where I was slowing down the way in which I was putting capital to work. And so I never ended up taking a position in the stock. So Airbnb is probably one that I would consider taking a sizable position in, because honestly, no matter what happens over the next, couple years even, I think this is a company that's poised to win over the long term. I would love to put cash into a business like some of that, because I would want to diversify across a few stocks, into some more biotech and pharmaceutical businesses, right? A lot of the types of companies I talk about here on the show. I'd even consider putting some of that to work in a company like Hims and Hers, which I actually do not currently own. So there's another example of one.
Nice.
But yeah.
So, all right. Sorry about that. Technical difficulties from my end.
Oh, you're good.
I just couldn't hear Rachel there. So it sounds like you went Airbnb, at least one.
Airbnb, well, because my point was I would probably want to diversify the 10K across a few stocks, but if I'm picking one that I'm really interested in that I don't currently own, Airbnb is one.
Yeah, I think I would probably go Viking Holdings, the cruise line. That's one I've been looking at quite in detail recently. I just haven't bought it yet, so I think I think I would put that one on my list. So.
Yeah, I think that's fair. There was a question that had come in. I thought this was interesting because we've talked about these companies recently. Ed was asking, who has a better earnings report tonight, Kava or Axon? So I guess we're, prognosticating a little bit here, because Kava, I think they report at 5 p.m. Eastern. I'm not sure when Axon reports. I think it actually might be right around the same time. I actually wanted to see, because Kava is one that I follow a lot more closely, and I wanted to see if I could pull up what analysts are projecting. So it looks like analysts are targeting for Q4 revenue for Kava to jump 26% year over year to 223.3 million, with same-store sales up about 17% year over year. They also are projecting that Kava will report earnings that will more than double to 50 cents a share for 2024. And they're also projecting a 23% gain in 2025 on an earnings per share basis to 62 cents. So there seems to be pretty high expectations for the company, you know, to give you kind of an idea of how that growth fits into where Kava has been. So again, targeting nice double-digit growth there on the top line. They're looking for earnings per share of about 50 cents. If you go to their recent quarter, right, in Q3, revenue grew 39% year over year to about 242 million. Net income was 18 million. This has been a business that I like because while they target a very specific, I think, niche of the quick service restaurant category, they've been able to really rapidly expand their profitability. They're free cash flow positive, which I also like to see. Their profit margins are pretty solid for, again, this category, right? They had a restaurant level profit margin of about 25.6% in Q3. So it seems like analysts have very, very significant expectations for the company. I mean, even looking at, the first 9 weeks, right, of 2024, Kava reported earnings of 45 cents a share. So they're looking at 50 cents a share for the full year. That doesn't seem like a far or overly lofty goal. So I think that this is one of those companies that if they even come in slightly below what analysts are projecting, you're going to see some real volatility in the stock. But just bear in mind, this is sort of the foundation of how the company has been doing recently. And they've been doing really well financially and increasing their profitability under GAAP, which you really like to see with these kinds of businesses.
Yeah. I'm going to answer this question by way of saying which one I think is going to have the most positive response. I don't know that I can say objectively who's going to have a better report because they're just two very different businesses, right?
They're really different.
These, right? But in terms of which one that I think is going to respond most positively in the market, either after hours or tomorrow, I'm going to say Axon here, because I think you've laid out the Kava issue, right? That there's a lot of expectations built into this. And I've seen several restaurant companies so far kind of head down after earnings this season, just from a little bit of a disappointment. I worry that they're going to disappoint just ever so slightly, and that's going to be enough to send the stock down a little bit. Axon, as we are aware of, went ahead and disappointed everyone last week or this week with their unrelated to earnings news. We've ended the partnership with Flock, and that's hit the stock down quite a bit. I feel like all they have to do is they need to do things, put up good numbers, right, that we've come to expect, and also reassure people that things are going to be fine without the Flock partnership. If they can accomplish that, I think we see it bounce back. So I think Axon's did a very good job of kind of setting the bar low for this report, and hopefully we'll see a nice bounce back. But we'll see. We'll see in maybe 30 minutes or so. Here we're gonna start getting these flowing in. Both those reports tonight, right? Kava's tonight and Axon is after hours. Yeah,
Kava's at 5 p.m. So I won't be able to hit it on this show, but maybe tomorrow on one of the shows, because I think that's one that's a lot of people are interested in, and I like that company.
Yeah, I think so.
I'm looking back through the queue. Well, I talked about this a bit earlier, but I don't know if you follow Chegg at all, but Irritable Investor was commenting that in other news, Chegg sues Google is down 20% this morning after earnings. I went through their earnings this morning on the 8 a.m. hour with Matt Frankel, and they had a pretty rough Q4 and full year report. And what's interesting is they've actually partnered with OpenAI to work to integrate, the AI capabilities like ChatGPT into their platform offerings. But on the flip side of that, the the continued expansion of these types of tools has also posed a real threat to how Chegg's business model works, right? Because if students can go and look up, type in their question and get answers with attributions, depending on the search engine they use, right? Then that can pose a real threat. Why would the student then go and pay a subscription for Chegg? I think that's the issue you're seeing here. With Google, Alphabet's Google in particular, Chegg is alleging in their lawsuit that they filed in the federal district court that Google's AI summaries of search results have hurt their traffic and revenue. And that essentially they are also working with Goldman Sachs to look at different options for the business, including potentially even going private or looking at like potential acquisitions. I don't know if they could be open to being bought out or what they're looking into. It's still very early to know, but something that they said in their filing was that they depend on referrals from the Google search engine for a large portion of their revenue. So something that Google has rolled out over the last year plus is there's all these AI summaries of search results, and depending on the market you're in, this actually isn't available in all markets. That you can put in a question, Google will bring up a bunch of basically a summary of whatever the answer is to that question with links to all of these different sources. So you can actually go and check the material yourself and make sure that it's actually accurate. And that kind of a model is something that could be and has so far proven to be a real threat to Chegg. So they're alleging, monopolistic practices. This isn't the first time we've heard that term used around Alphabet, right? They cited in their filing a ruling by a federal judge last year that Google holds a monopoly in the search market. So this is interesting. I'm going to be following this one. It's like I have liked the concept of Chegg as an ed tech company, and I find it kind of sad to see how the business is faring right now. This isn't a company I've owned, but they have a real uphill battle right now. So you could see a situation where maybe they go private, maybe they're acquired by a bigger firm. Remains to be seen, but that's what's happening there.
Nice. Sadif noted IonQ made revenue from defense academia contracts. What are those contracts? Yeah, so they did have revenue, right? We know that they had revenue, just not nearly enough to pay their expenses right now. So they get revenue. This is IonQ, the cloud computing company. We were one of the ones, the pure plays we were looking at. So what they really want to do, right, is that they provide access to their computers, their quantum computers, on various platforms. Like customers can use these through Amazon Web Services, through Microsoft's Azure, through Google's Cloud Marketplace, right? So you can go on there and you can access their cloud computing system, and they generate revenue that way, right? So there's a little bit of that. They also have partnerships and contracts with various research facilities to, I suppose, both use their hardware, but also to develop quantum networking hardware, right? Quantum computing networking hardware. One of those, probably the biggest one, is with the U.S. Air Force Research Lab. That's around a $55 million agreement that they've got with them, and they also have similar arrangements with the University of Maryland and some other companies aiming to, kind of develop quantum computing applications, including what you noted, Rachel, the drug discovery stuff they're working on. So there's a little bit there, but mostly these are research partnerships, collaborations that they get a little bit of money from these other groups that they then use to kind of, it's kind of a joint venture type of arrangement, from what I understand there. So that's what that is, Sadif. All right. I also wanted to throw out this some news I just saw, Rachel, which is do you know Technicolor?
I don't think so. I don't think I know that company.
You know the name, right?
I know the name, but yeah, I don't know them very well.
So I doubt many of our viewers are invested in Technicolor. It is a public company, but I believe that I'm looking at the investor relations website. It's a French company now, Technicolor Group. and so they're traded, I think, on the Paris or one of the European exchanges, I
They
believe.
trade as Vantiva now. Is that the same?
Oh,
The
is
same
that it?
company?
Okay.
Formerly
All right.
Technicolor SA. I believe
Yes,
that's
yes,
okay.
yes, that's right.
Yeah.
Technicolor SA. So they seem to be in a spot of trouble and seem to be winding down operations, which could impact some Hollywood studios to some degree. I don't know how much, but you know, this is been around since 1915, right at the beginning of the Hollywood film boom, way back in the day. Technicolor, right? They colorized.
Right.
They provided the color for when we first started filming in color. So it's a little bit sad if you're a film buff to see this. I suspect that it won't be liquidation. It'll be, you know, if they do go into receivership, what they apparently have positioned the French government to do. That the bankruptcy system's a little bit different out there. You will end up seeing pieces of this sold off or absorbed by others, I would suspect. But you know, we all know them from back in the day, like Technicolor for the Ten Commandments, right? You know, that kind of stuff. But very recently, they've been involved on films like Harry Potter, the recent Lion King prequel Mufasa. They were involved in. So they've been doing stuff like right up until the end here. Like it is still a viable. Well, viable is the wrong word, I guess, given the bankruptcy situation. But the technology is still there, right? And they are still active in Hollywood. So you know, a little bit sad. We'll see if any of the companies we know in that space decide to pick up some of this or how that bankruptcy proceeding develops. But your bankruptcy news of the day, my friends.
This actually makes me sad. So I am an old movie film buff. I grew up on almost exclusively old films. So like anyone who's familiar with, you know, Wizard of Oz or Snow White or Pinocchio, some of these older movies, Gone with the Wind, obviously, like Technicolor was and has been a colorization process that was revolutionary for visual storytelling at the time. So it is kind of, I think it makes sense given where we are from a technological standpoint and how filmmaking has evolved. But yeah, just from a personal note, I find that a bit sad.
Yeah. Yeah.
Sadaf was saying he was asking about Jazz Pharmaceuticals earnings, which, oh, I see. Those are at 4:30 p.m. Eastern. So Sadaf was saying, wanted to ask for a live earnings reaction. Sad to see the schedule, maybe tomorrow. Yes, I will put this on my list. Thank you for bringing that up, Sadaf. I appreciate it. I will put this on my list to try to cover on one of the shows tomorrow. I'm on a few times later in the day tomorrow. So stay tuned. I will take a look at their earnings report when that comes out.
Yeah. I was trying to think about T-Stock's question here, which from 3 minutes ago, excluding the Magnificent Seven stocks, which mega cap is best in terms of valuation right now? It's a good valuation question. The problem is that if you exclude the Magnificent Seven, there's your top seven, like just gone off your list, right? Now, 1, 2, 3, 4, 5. Who are the Magnificent Seven, Rachel? Who's in that group now? Apple, Nvidia, Microsoft, Amazon, Alphabet, Meta,
Right.
Netflix. Is that the seventh still, or are we calling
I
Tesla the seventh?
believe so. I'm trying to check. I think now Tesla is the seventh. Yeah.
So Tesla's 7 and the Magnificent Seven, right? So Tesla's actually number 10 ranked by market cap right now. They've seen a decline recently. But if you take currently the top 7 by market cap companies in the world include 6 of the Magnificent Seven. So all of them except Tesla, plus Saudi Aramco. And I'm not going to opine on that one because I have not looked into the business. I don't know whether I would think it's overvalued or not. That's about a $1.8 trillion company by market cap if you do the currency translation there. So that's your top. So let's exclude those out and let's exclude Tesla from our answer here. So the rest of the top 15 based on this listing I'm looking at here. So we got Berkshire Hathaway, Rachel. We got Taiwan Semiconductor. We've got Broadcom. Broadcom got Eli Lilly. All right.
Oh, there you
Eli
go.
Lilly is a $800 billion company. We got Walmart. So let me give you your market caps of these, right? So we got Berkshire Hathaway at 1.1 trillion, call it. We got Taiwan Semiconductor at 980 million. Then there's Tesla. We're going to skip them. We've got Broadcom at about 950 billion. Eli Lilly about 811 billion. Walmart about 780 billion. JP Morgan Chase at about 720 billion, and Visa at about 680 billion. So off the top of your head, and it's hard to do this, right? We'd have to look at each one and look at the multiples and see what we think. But let's just give a quick answer. Between those two, which ones would you think have the best valuation right now? Again, Berkshire, Taiwan Semi, Broadcom, Eli Lilly, Walmart, JP Morgan, and Visa. Which one did you gravitate towards?
Oh, I mean, I have to say Eli Lilly, even though I know the valuation is really steep.
That's fair. That's fair.
Because I think it's just a stellar business. But also, Visa is an interesting one. Visa is an interesting one. I would say off the top of my head, those two would be the ones I'd gravitate towards the most.
Yeah, I want to say either Visa or Berkshire. For me, in terms of which one I would think has a good valuation, I would probably say Berkshire or Visa of those. So, yeah, there we go. So between the two of us, T-Stock, if you want a single answer, since we both noted Visa, I'd say go Visa.
Yeah, Visa actually trades at a price to earnings of about 35. So not as bad as it could be. By comparison, Eli Lilly's about 77 price to earnings. So I already said this is the one that I gravitate towards the most. I'm a shareholder. I love this company, but they are not cheap by valuation standards. Yeah. But they're
tough.
They're
and
a fantastic
the reason
business.
This is a hard question, T-Stock, I think, is because if you're saying, like, when you get into this world, mega cap, you're gonna, I think, just by default, gonna see some premium valuations, because otherwise, how do you get there?
Right. That's part of
it's
it.
rare to have a company trading at these rarefied levels. We're saying, the cheapest one is Visa. Not cheapest. The lowest market cap is Visa at about 680. And that's the only one of the top 15 that is less than 700 billion in market cap, right? So I don't know how you get to be that big with that big of a market cap and not have some kind of premium valuation. Otherwise, why would?
Yeah, that's the thing.
You'd have to be a massive conglomerate, right, to have that happen, to people not, for investors not to be giving you a premium valuation to get that big. You'd have to just be like this massive sprawling business that no one loves, but just happens to have a ton of assets to get up there. And none of these, well, maybe Berkshire, you'd say, is that. But people love that one. So
yeah.
So it's up. But thank you for the question. It's a very interesting question. Really interesting question to think about and ponder.
That's a fun one.
Yeah.
There was a question that came in actually a few days ago that I wanted to hit because I thought this was kind of interesting, from Cyber Mikey. ITW is a fave dividend investor, rec of mine. What are your thoughts on the company? So I don't know if you know this one, Toby, but that's ITW is the ticker for Illinois Tool Works. They have a market cap of about 78 billion. Shares trade about $264 a share. They are a long-standing dividend payer. I think they have, if I get this right, they have paid dividends every year for, I believe, 50 or 51 years in a row. And they have, faithfully raised that dividend through the years. That yields about 2.3%. So this has been a solid one. But they're a Fortune 500 company. They design and manufacture industrial equipment and components, right? So their products are used in industries like automotive, construction, and healthcare. So, for example, they manufacture components and fasteners for automotive clients. They also supply like commercial food equipment and related services to clients in the restaurant space. They even make things like adhesive, sealants, lubrication for auto aftermarket maintenance. And then they also make things like consumables and equipment for testing and measuring. They have manufacturing facilities and offices, not just in North America, but throughout Europe, as well as in China. And they market their products directly to these industrial manufacturers, but also they work with independent distributors. This is a company that's been around, I think, since 1912. So they're an old business. They're not, a high growth business. I think in 2024, their revenue actually decreased by about 1%, but they had a pretty solid and record for them operating margin of 26.8%. And then record GAAP earnings per share of 11.71, which was up 20% year over year, which was more than made up for that very slow, top line figure. So this is an interesting one. I mean, I think it's part of it is having to understand, the different industries in which they operate and kind of the types of tools and products and services that they provide. They do have a really diverse base of clients they work with. You could think how, some of their clients, say in the automotive sector, could be, impacted depending on how things like tariffs evolve in the coming months. But they also have other sectors that they are selling these kind of essential tools to. And so I like this one. I think it's kind of interesting. They, like I said, they're not like a high growing business necessarily, but they're very profitable. As I said, record GAAP earnings per share this last year. They also reported record free cash flow of $1 billion in Q4. So that was something that was notable. So yeah, I like this one. They have a really pretty solid balance sheet. I think this is an example of a company that's like a little bit boring at first glance. Sometimes those boring little businesses are really great growers in your portfolio over the long run. And this has been, I think, the stock itself has not necessarily been the highest of performers, but that dividend appreciation over time, I think, has been pretty notable.
Right. So let me hit this question going back a little bit from Ed 4 hours ago. CrowdStrike Chief Security Officer Sean Henry retiring on March 31st. How will this affect CrowdStrike? So it's going to impact him a little bit, I think. Clearly, right? He's the Chief Security Officer, right? So there, you will see a little bit of an impact there. I'm not too concerned about this. So Mr. Henry here, Sean Henry, he's been with the company since 2012. So 13 years now, and he came over from the FBI. He had a 24-year career at the FBI. So they said this decision was mutually agreed to on March 14th. I'm not. It seems like it might just be a retirement, right? That he just might be done. I don't know if there were other things like the hours that might have contributed to this. It doesn't seem like that. You've got a guy who, I don't know his exact age, but looks like he's in his late 50s, early 60s, who might just be sitting there thinking, nice career. He already does some lecturing and whatnot at various universities. It might just be he wants to do something different, right? Take a step back, take it a little easy, have a nice retirement. I think that's probably the main driver here. It looks like I'm looking at the press release from here. It looks like he's going to stay on board as an executive advisor to the CEO, right? So that's his title, executive advisor to the CEO. I don't know how long that is expected. He's expected to stay on. I'm looking at look at the filing here. Yeah, he will remain with the company, will transition to the role of executive advisor to the CEO. No time frame given on that. So there'll be some transitionary period, and they haven't announced if they're going to hire someone else in the role or restructure the reporting structure, how they do that. We'll see what they decide. But it looks to me like it's just time to retire, time to do something else. So I think that's all there is, and I wouldn't be super concerned about that right now.
Besties had asked, would you buy Kava now? How cheap will Kava need to get for you to buy it? So for me, it really hasn't been, at least personally, a matter of valuation. They have only been profitable since early 2023, which was, shortly after their IPO. So they have a series of quarters now where they've been working to get to consistent profitability. That's just something I really like to see before I put cash into a business, especially when a business is in kind of the first few years out from IPO. That's just kind of been my personal thesis. Now, to put a little bit of an idea to those metrics, it's very hard to accurately look at Kava Group's PE, in my opinion, which is right now like 254. And part of that is because they have been newly profitable and working on getting to consistent profitability. So that's something I bear in mind on a price to sales basis. They're trading at about 13. Now, for comparison purposes, a bigger company like Chipotle trades at a price to sales of about 6. So they are somewhat on the higher end of the valuation spectrum for a business at this point. I probably wouldn't take a huge position in this for my portfolio, but I do like the business. And for me, it hasn't really just been a matter of valuation so much as it has been seeing how does the thesis play out post IPO. Are they able to achieve consistent profitability? And those have been the biggest things I've been watching for. Even more so than valuation, because as I mentioned, there's some factors in those figures that you can't entirely rely on the trailing PE right now because it has really fluctuated.
Yeah. We have a couple minutes left, 3 minutes left. Let's see here.
I know I'm scrolling through.
Yeah, I'm just trying to find when we can answer quickly here.
Ed had said a few hours ago, thank God for healthcare stocks on days like this.
Yeah.
I feel you there. I do feel you with that one. Do you follow Home Depot at all?
A little bit, yeah.
Yeah. So 4 hours ago, Matt had asked, and we talked about this a little bit this morning, but for anyone that maybe didn't hear a discussion on that, Matt was saying, good morning, fools. Given the release of the Home Depot earnings report, what's your outlook on the company and the stock? The biggest issue they've been dealing with is just the nature of the housing market right now. And people are being extra cautious with any kind of discretionary expenditure. So things like updates to the home or, building a new deck, which we've seen with companies like Trex or some of these other really discretionary types of purchases, I think consumers are really scaling back on. Now, that being said, they did have a pretty solid, again, for a business of this maturity, performance in 2024. Their sales for the fiscal year were about $160 billion. That was up 4.5% year over year. And this was despite the fact that they actually saw a slight decrease in comparable sales, but overall sales were up, in the mid-single digits. Net earnings for fiscal 2024 were $14.8 billion compared with net earnings of $15.1 billion. So slight deceleration, but still profitable. The president and CEO said that their Q4 results exceeded their expectations. They did see greater engagement in home improvement spend, even though there's really ongoing pressure on large remodeling projects. They are a really faithful dividend payer, which is something I really like about the business. So they are entering their 152nd consecutive quarter in which they've paid a cash dividend, and they recently increased their quarterly dividend by about 2.2%. So I personally really like this business. I think, looking at this as a long-term investor, the environment they're in is the biggest hurdle they have right now, not anything the company's doing wrong.
Yeah, and it's up about 3%, which is pretty good. It's a decent size movement for this type of company, for Home Depot. So market is receiving the report relatively well. So that's good. Yeah, I think they're going to be fine. Like, this is one of those steady growers, Rachel, where I think what we saw from earnings is what you want to see, and you shouldn't expect you don't want surprises from this company, frankly. You want to see the steady growth, maybe slightly exceeding expectations from time to time. But I think a good part of what they're going to do, right, is dividend and share buybacks as they continue on this steady size. That's just kind of what they are. But yeah, I think it was a fine report. All right, that is it for us, Rachel. We're gonna be heading out of here. For those of you on our YouTube stream, that is the end of our streaming for you today. Please come back here tomorrow. We'll have another couple hours for you then as well. For those of you members who are joining us through the Fool website, stick with us. There'll be a short transition period, and we will continue the coverage for the next few hours here, starting with a look at earnings coming up here with Samit and Neil. So stick around.